We will start. Just a few opening remarks and a little bit about this. Welcome to the Financial Planning Challenge 2013. For people who do not know how this works, I will go through some of the things. First of all, this is a partnership, a great partnership with CFP Board, Ameriprise, and FPA, where we bring students to the conference in order to show their stuff, but also to learn and so we can learn from them. How this is handled is that early in the year, we present to the schools a case, and they will then write a financial plan. The plan is written without any software. They are allowed Excel spreadsheets, their calculator, but there's no financial planning software. It is really basically from scratch. Those are submitted to a panel of judges, not the same that we have here, so we don't want any prejudicial attitudes coming in from the written programs. Of the schools that submit, we pick the top 8 performing top 8 plans, and then we have them come to national conference to present. This is phase 2. It's the oral presentation. Now, just so you know, if you think that the judges are cold and cruel, that's part of what the judges have been told to do is there is no reaction, there will be no interchange with the students. So it's not that they're being not nice. It's something that we want the students to act. The judges will be as if they are their clients. And we have as judges representing CFP Board, and forgive me if I forget names, Marty Gillen, David Bresler. David Bresler is from Ameriprise, and Valerie Porter from FPA. So tomorrow will be phase 3, which is a how do you know, kind of like a Jeopardy challenge. We will keep to a tight schedule. The students are given 20 minutes to present. There will be 5 minutes of setup. There will be 5 minutes of setup, and that starts going when we will cut a close. And somebody is here too. They will be given a 5-minute, a 2-minute notice as their time is running through. That's about enough what we have to do today. What do you have, Mary? Oh, exactly. Yeah. Yes, and just a reminder that if they're not allowed in the room, if there are any students, for competing students, they are not allowed in the room. We trust you on that, but we have no students and no competing teams here. We want it to be impartial so nobody feels they have an advantage. The judges will kind of hold back a little bit until they get a base score, so there really is no problem with who goes first. It will be fair judging along the lines. So today, first of all, yes, first school up is going to be Texas Tech. And from Texas Tech, our team is Rochelle West, Jamie Engelken, and Samuel Honey. No? Kansas State. Texas Tech, okay. Wait a minute. Where are those glasses I gave you, Valerie? Oh, I'm sorry. Here we go. I'm sorry. Blake Bonner, Emily Brooks, and Jennifer Hill. Thank you. Oh, I'm sorry, because we are taping this. That's the other thing that will be happening. We are videoing this. We are video recording so that people will have and be able to see the presentations and hopefully learn from that and learn from my mistakes that I have to talk into the microphone and make sure I know who's going to be presenting. So at that point, Texas Tech, it's time to start setting up.
I'm glad you made the first mistake and not me. Make sure you take that clicker with us. Coming in, guys. It's good to see you. I hope all is well. As I'm sure you remember, I'm Blake. This is Emily and Jennifer. After our last meeting, we identified a list of goals that you had stated you'd like to achieve with your financial plan. Have any of these goals changed since we last met? And have there been any additional goals added? Very well. There are 3 areas of your financial plan we'd like to talk on today. I'll discuss the retirement portion of your financial plan. Emily will talk on the income tax portion of your financial plan. And Jennifer will touch on the adoption and surrogacy decisions you'd like to make. Starting with retirement. Mark, you'd stated you'd like to retire when you were 65. Jeffrey, you stated you'd like to retire when you were 68. And your goal was to maintain your financial stability through retirement, living on 80% of your current expenses. Have any of these specific goals changed? Very well. Currently, you have 5 retirement accounts between the 2 of you. Mark, you have a self-employment pension, a stock bonus plan, and a 401k. Jeffrey, you have a 401k and a simple IRA. Of these 5 plans, only 2 of these plans are currently active. Do you have any questions? Good, that's a great question. The difference between an inactive and an active plan is simply that an active plan means you're currently participating in that plan's account. In other words, you're currently contributing to your SEP or your stock bonus plan. So Mark, you're currently contributing to your SEP or you're currently participating in your stock bonus plan. Does that make sense? Very well. We've identified a number of retirement income sources. Of course, your retirement accounts, your brokerage account, your inheritance that you plan to receive from Mark's parents at retirement, your Social Security, and your rental income. Of these income sources, has there been any major changes since we last met? Good. I would like to point out one change to your Social Security since we last met, however. Due to the Supreme Court's recent rulings on DOMA, it now allows us to maximize your Social Security survivor benefits. This is a decision that will need to be made as you get closer to the age where you can actually claim your Social Security. However, we would just like to make note that we are aware of the changes and how it affects your plan. So to achieve your financial freedom strategy through retirement, we would like to implement the following. First, we'd like to consolidate your inactive accounts that I alluded to earlier into IRAs. This will give us a little more control over those assets and allow us the flexibility to properly continue to diversify your portfolio. Mark, as we had discussed earlier, you have the option to employ your spouse. By employing Jeffrey, it allows us to maximize our tax-deferred retirement savings by setting up another avenue to save tax-deferred money. Does this make sense? Very well. Also, Jeffrey, your new employer plans on setting up a safe harbor 401k. We encourage you to contribute to your new employer's safe harbor 401k. And we will also plan to utilize your other retirement income sources, such as your inheritance, Social Security, and the rental income. So what would your new retirement saving strategy look like? Mark, you would have your self-employment pension that you currently have, or we could set up a 401k, and I'll get into the details of that in just a minute. You have your current stock bonus plan, and then your IRA. Jeffrey, you'd have your 401k from your new employer. You'd also either have a self-employment pension or 401k set up under being employed through Mark, and you would also have your IRA. The 401k, we'd recommend you save the minimum of your employer's match. How that works, and the details, we need to see the 401k to see the investment options and the details of how the plan works. For a typical safe harbor 401k, the employer match, if you contribute your 5%, the employer will match 4%. We encourage this because we kind of like to view the match as free money, and taking advantage of free money is something we feel would be very advantageous to your plan. Any additional contributions to your 401k, we would need to look at the details in the investment menu and investment options of the plan. Does that make sense? Next, the SEP and the 401k. We'd like you to, the SEP or the 401k, I'm sorry. We'd like you to concentrate the majority of your retirement savings in one of these two vehicles. However, we'd need to talk more in detail and get a little bit of feedback from you to decide which one of these two vehicles we want to choose. The reason being, the 401k has a little more personal liability associated with it, and that's something that we would like to get a feel and a feedback from you before we make that decision. So we'll talk about that at a later point. The IRA, of course, would be for the inactive accounts that I had talked about earlier. And that's because it will give us control over those assets and let us maintain the flexibility to diversify your portfolio properly. And the stock bonus plan, you don't have a whole lot of control over when you receive that. However, when you do receive that, of course, we will accept it. The one problem we can not necessarily a problem, but the one issue we can foresee going forward with the stock bonus plan is that it might create a concentration risk in the portfolio as a whole. We can diversify away from this, and this also speaks to the importance of the SEP or 401k, whichever one we decide, or the IRA, by giving us the flexibility to diversify your portfolio because we have more control over those assets than we would your employer's 401k. Does this make sense? Do you have any questions for me? I know this can be a little overwhelming. It's a lot to take in at one point in time. However, if you leave here today and you have any questions that arise, don't hesitate to contact us. Any of us on the advising team would be more than happy to answer any of the questions you have. However, if you don't have any questions at this time, I'll let Emily talk about the income tax portion of your financial plan. Emily?
Once again, Mark and Jeffrey, thank you for being here today. As Blake said, I'm going to be talking about the income tax portion of your plan. And what we're going to start with is the plan we gave to you back in June and the recommendations we had in there. So at the federal level, at the time, you were unable to file as married filing jointly. However, we had you filing as single on 2 separate tax returns. Now, at the state level, because New York State does recognize same-sex marriage, you are able to file as married filing jointly. However, we had to create a dummy tax return in married filing jointly in order to get the starting point for your state tax return. Now, at the local level, New York City does impose a municipal tax, and this is something that we've accounted for in your cash flow statement. And when it comes to retirement, as Blake mentioned earlier, we will be doing rollovers from your inactive accounts into an IRA. And how we're going to do this is through a direct rollover. So the money or funds will move from one account, from one custodian to the other, and you'll never touch the money. So therefore, there will be no taxes that have to be paid. It will have to be reported, but like I said, you won't be paying anything. So next, we're going to look at the changes to DOMA. Over the summer, actually on June 26th, they actually invalidated a section of DOMA, and what the effects of this were that same-sex couples could now file as married filing jointly at the federal level if the state they lived in recognized same-sex marriages. Then in August, they even went a little bit further and made the decision that if you had been married in a state that recognized same-sex marriage, no matter what state you lived in now, you could now file your federal tax return as married filing jointly. So now going forward, what we're going to have you do is begin filing your federal tax returns as married filing jointly. This will eliminate the need to make that dummy tax return for your state tax. And we're also going to look with your accountant at previous year's tax returns up to 3 years back. And if any of those can be amended to provide benefits, if you would have filed married filing jointly, then we will have your accountant consider amending those. And if you would have received a refund, you will receive that with interest. So do you have any questions regarding this information? Okay. Now Jennifer's going to touch a little bit on adoption and surrogacy.
All right, Mark and Jeffrey, as you previously stated, one of your lifetime goals is to care for a child. And so here I looked into the options of adoption and surrogacy for you. An adoption is a lengthy process. It's a 7-step process usually, and it involves applying to the state that you want to adopt, looking for an agency, going through the home study such as training, and then meeting the child, and then finalizing it in court. It could usually take up to 2 years or longer for it to be finalized in court and have the child placed in your home. A typical average cost is $20,000 to $40,000, and as of January this year, there's a permanent adoption credit that is available. It's about $13,000, but you may want to see your a tax accountant if you meet certain limitations. Do you have any questions? All right. And surrogacy, there's 2 types of surrogacies. There's traditional surrogacy, which is the egg is coming straight from the surrogate, and then there's gestational surrogacy, where the egg is coming from a donor that you specifically looked for. Both surrogacies are illegal in New York City or New York State as of right now. If you're involved in such contract, you're fined $500. If you're involved creating the contract, you're fined $10,000. And if there's a second offense, it's considered a felony. There's 2 exceptions that you can get away with the surrogacy, and that is finding compassionate surrogacy, which is someone that's willing to do it for free, minus medical expenses, or going to another state and doing the process in that other state, such as Maryland and California, which is surrogacy friendly and same-sex friendly. A typical cost is $80,000 to $100,000. And after doing research and analyzing 8 different agencies in New York City, I have found that these adoption agencies to be respectable, and that will benefit you. And now Emily will touch on the action plan.
Yes. Now, leaving here today, there's a few items that we're going to have you complete, and we'll provide you with a copy of this after the meeting. Starting out, we would like you to contact a few of the adoption and surrogacy agencies that we recommended. Then we would like you to look into participating in a safe harbor 401k if offered by the employer. We would also like to work with you to roll over the inactive retirement plans into IRA. We would like Mark to look at employing Jeffrey to set up the SEP or 401k. We would also like for you to look with your accountant at amending previous year's tax returns. And then we would encourage you to file your 2013 tax return as married filing jointly. All of these items we are more than welcome to help you complete. And if you have any questions, as Blake mentioned earlier, feel free to give us a call or stop by the office, and we can help you out in any way necessary. Now, is there anything else we can help you with today? All right, thank you. We hope you have a great day.
Thank you for coming in. It's good seeing you again. Thank you.
Here's a
Take
copy
care.
of the
Thank
action plan, as I said.
Have a
Thank
great
you. There you go, sir. Thank you.
Have a good day.
Here you go, ma'am. Thank you.
Have a good day.
We're going to give the judges, they'll confer for a few minutes, and they will make some comments to the students. Yes, we can clap. It's completely fine. If you hadn't noticed, and you didn't pick up on it, this is a same-sex couple that the students are working with. We threw a little curveball in, knowing full well the written plans had to be submitted by June 15th, and we knew that the Supreme Court decisions were going to come down after that. And so there might be an adjustment. There's going to be a written plan, and then we wanted to see how the students would stay up with the law and see what was happening and make the adjustments as they did the presentation. If there are just a couple of things. If there are competing students are not allowed in the room, just in case you didn't know. And if you are from a competing school, we do ask that you just keep the competition to yourself and not report back to your peers. We trust you on that one. So, every team, by the way, with the things, every team is given 5 minutes for setup and then a 20-minute presentation. We do have cards. They will be worn to 5 minutes, 2 minutes, and at the end of their time, they will be stopped and they will not be allowed to complete the presentation. We'll be doing 4 teams before lunch, and then we'll do the other 4 teams after. Tomorrow in the afternoon, in this room again, will be the phase 3. As I said, it's kind of like a Jeopardy round. And then the winners will be announced at the closing general session. All teams get recognition, and they really deserve the recognition from the people from our group. The winning team will receive a $10,000 scholarship for their school. The second place team, and I don't want to quote the dollar amount. What is the second place? $5,000, and the third place team will be a $1,000 scholarship for their schools. I didn't want to start throwing somebody's money around there. By the way, I would really encourage your friends, and if you see people just, as the members especially, FPA members who are here for the conference, I worked as a panelist, as a judge last year, and it was one of the most exciting things that I've done at these conferences. I think it's a really worthwhile thing. We hope that this grows into a good competition. One thing we did differently this year was that we limited it to 1 team per school. We were really pleased with the amount of people that put in applications and submitted plans. And it was good because I think it generates some competition within the school itself, and it also gives opportunity for people who feel that maybe the field is a little bit more even for them to first get in. So it's been a good experience. Excuse me? 14. All right, I will let the judges make comments. You can decide which order you're going to go.
Hi, Texas Tech. Thanks, guys, for the presentation. I really appreciated it. I'll give you some general thoughts about the team and then some specific ones for each of you. So the few things that I just really appreciated was in each section, you took the opportunity to sort of review where we were, and it was really clear to me how you were progressing through the presentation, which I really appreciated. The other piece that you did a great job on, all of you, is checking in consistently with us as the clients to make sure we either understood or if we had questions. I mean, that is that's really, really important as you meet with clients and make sure that they're on the same page and make sure that they're understanding some of the things that you're talking about. So Blake, you covered retirement. Generally speaking, I really appreciated how you went through retirement. A few notes for you. On the positive side, what I appreciated you calling out the risk with the stock bonus plan and the risk of overconcentration. That's one that's oftentimes missed, and clients don't necessarily understand how important that can be. I also appreciated your check-in around DOMA and some of the impact there for Social Security, even though it's a ways out. Just to point that out was really helpful. The one thing I would point out that would have been nice is you used account titles, 401k, that sort of thing. It might have been helpful to see the dollar amounts in some of those accounts to help me as the client understand, what are we really talking about here. Sometimes that the titles of accounts we use a lot in the industry, but clients don't necessarily always understand what a safe harbor is or what have you. Emily covered taxes. I thought you did a great job at a number of things. Laying out the timeline for DOMA, just as how things have happened over the last couple of months, was really helpful. Also explaining how a rollover works and that there are no taxes, sort of explaining that process was really helpful as well. The one thing I would have loved to see, it was great that you mentioned leveraging the account to go back and look at taxes over the last couple of years. Might have been helpful to spend 30 seconds reviewing some of the pros and cons and how that might not be a cut and dry, simple opportunity. So Jennifer covered adoption. Very impressed with the research. I mean, that was more than I expected. Both not only with sort of the helping me understand some of the challenges out there and how it works, but also going as far as to figure out which agencies might be the best ones to leverage. I actually don't have a ton of negatives on that section. That was a great job. Overall, as you got to some of the to-dos, I appreciated you working through the to-dos. The only piece I would add in is making sure that it's really clear to me how to do certain things. So I might not know how to employ my partners. That's one who's actually going to help me work through that. That would be the only piece of feedback I have on the to-dos.
Hello, I think you all did a great job as well. Just a few comments. You touched on a lot of them that I had wrote down. Definitely good to talk about the diversification and bringing in the DOMA changes was excellent. As far as employing Jeffrey, it's bigger than just some of the 401k and that kind of stuff. So again, referring the other changes and things they would have to think about as far as other professionals to talk with and what else, it might involve, such as paying Social Security taxes and, different things like that as well. The adoption stuff was really good, Jennifer, as well. I think there was just a couple places, like the tax credit, it has limitations, and maybe going into a little bit more detail about what that is to help them think through where they could find the information as well. And then, again, adding some specific dollar amount examples would have been helpful. But overall, really good job. Thank you all.
They've touched on several things that I also noted. I really appreciated the rationale that you gave for the decisions or the recommendations. It's so important for clients to understand why. We get it. We've spent time poring over this and doing that, but for clients to know the why behind what they're doing, that helps so much with motivation and actually getting them to do what you're recommending. So that's really good that you had that in there. The only thing with respect to the adoption, again, I appreciated the research and information on that. And I know it's hard and we're in an artificial setting and there's no feedback, but that's a very personal and emotional decision. So warming that up a little bit would be good. Good job, guys.
The next team up, excuse me, now that I have my order so I won't make another mistake, is Kansas State, and I'll get those names right. For people who were not in earlier, our three judges are Marty Gillen. She is representing CFP Board. David Bresler is representing Ameriprise, and Valerie Porter is representing FPA. It's a really rough job, I'll tell you, to do this. It really is. It's very impressive, the research and what these students do. And it's rough, so I feel for you guys. It's not easy.
Starting, yeah, no. We're testing the mics.
Okay.
Is it good? Are we? Okay. No, keep talking. Hello, how are you doing?
How are you, Rochelle?
I'm doing really well.
Oh, good.
How are you?
Thank
It's been your day. How was your day?
Okay. I
Keep
don't know.
talking.
Keep talking still?
Yeah, keep talking.
Go K-State.
Our judges, we have Dr. Marty Gillen from University of Florida, missing the football game. David Bresler and Valerie Porter. David is from Ameriprise. Dr. Gillen is from representing CFP Board, and Valerie is representing FPA. The case for the people also who came in is a same-sex couple living in New York. We did it purposely. The first written presentations were put in prior to the Supreme Court decisions, and so there was some work that our students had to do and stay abreast of topical things of how the law was changing so they could address their clients properly. Next up, even though I've introduced them once, is Kansas State, and we have Rochelle West, yeah. Raquel Welch, yeah, right. Rochelle West, Jamie Ingleton, and Samuel Honey.
Thank you.
Well, Mark and Jeffrey, we're excited to have you back with us at Bluemont Financial. We know it's been a little bit of time since our previous meeting, but we have a lot of good information for you today. We're proud of the financial plan that we've created, and I just kind of want to refresh you on who we are. This is Rochelle West, this is Jamie Ingleton, and my name is Sam Honey. And so how this presentation is going to work today is we've taken your financial plan and just picked 3 components that we think are the most relevant to the goals that you provided to us. And how the order is going to be, Rochelle's going to talk about your financial statements, and then Jamie's going to talk about retirement and investments, and then I'm going to close out talking about income tax. So, Rochelle?
As Sam said, we're going to begin by talking about your financial statements. You voiced to us that your budget was very important to you, so we want to address this. The first financial statement we're going to discuss is your cash flow statement. The cash flow statement's purpose is to determine those areas in your current spending habit that you can make changes to meet your financial goals. The goals you expressed to us were to become debt-free, to create that emergency fund, manage your variable expenses, and create a home improvement fund. To solve your cash flow, we take your total expenses and subtract it from your total income. Looking at your cash flow in depth, we see that you have a surplus of roughly $45,000. Later, we're going to discuss what we recommend you use this surplus for. The next statement we're going to discuss is your balance sheet. Your balance sheet is used to solve for your net worth, and we take your total assets and subtract your total liabilities. This net worth is just a snapshot of your current financial picture, so it changes as assets and liabilities change. Looking at your net worth, we see that you have a net worth of roughly $380,000. We'd like to see this number grow as we continue our relationship with you, but this is a great starting point. The next thing we're going to discuss is how we analyze those financial statements. We analyze the statements by using ratios. These ratios help us interpret the numbers we see on your cash flow and balance sheet. They help us identify those areas where we can make changes. And we use target benchmarks for comparison to see how well you're doing. The first ratio we're going to discuss is your emergency fund ratio. This ratio is used to discover how many months you can cover your monthly expenses with your current monetary assets. A benchmark of 3 to 6 months is the recommended, and we like to see 6 months amount saved ideally. And your emergency fund ratio is 0.55, which means you have approximately 2 weeks covered of expenses if an emergency were to occur. So we're going to address how to increase this ratio when we talk about your goal of creating that emergency fund. The next ratio we're going to discuss is your debt ratio. And this ratio is used to discover how many assets are being financed by borrowing. The benchmark for this is a maximum of 40%, meaning you should have no more than $4 of liabilities for every $10 of assets. Your debt ratio is 19%, which is well below that 40%, so you're doing fabulous in this area. The last ratio we're going to discuss is your debt-to-income ratio. This ratio is used to discover the percentage of income committed to paying off those debts. A ratio of less than 15% is considered safe, with a ratio less than 10% being like the optimal ratio. And your ratio is 10.3%, which is right at that optimal level. So again, you're doing really well in this area. The final thing we're going to discuss about your current financial statements is we're going to give you some observations we have on your current financial spending, and then we're going to give some recommendations on how to reach those financial goals you addressed to us. And some observations we have is you have a positive net worth and an annual surplus, and your debt ratio and debt-to-income ratio are well within those benchmarks. As I said earlier, your emergency fund ratio is below the benchmark, but we will address this. I'm going to give you recommendations based on those goals we listed earlier, and we're going to begin with your goal of becoming debt-free. We recommend paying off those credit cards first, starting with your Visa card because it's your highest interest rate card. This will allow you to save more money over time. We do recommend that you continue to pay those minimum payments on your MasterCard while you're paying this card off, but if you can pay a little bit more than those minimum payments, again, it will allow you to save more money and pay those debts off a lot quicker. After you've paid off those credit cards, we recommend you start paying off your loans, starting with your insurance fund, then followed by your auto loan and mortgage loan. This is, again, used because we want you to save more money over time, so we look at those interest rates to make sure that you will save the money. We would love to sit down with you and discuss your monthly expenses so that we can discover places you feel that you are comfortable in cutting back so that we can save more money monthly to reach those goals. And we want to make sure that in the end, every dollar is accounted for and we know exactly where your money is going. The next goal we're going to address is your emergency fund, to build that emergency fund, which will improve your emergency fund ratio. We recommend using that surplus we saw on your cash flow to start this fund, and 6 months of expenses for you is approximately $150,000. That is a lot of money to just have sitting in a savings account, so we do recommend that you take a portion of it and keep it very liquid and easy accessible, and then take another portion and invest it to allow it to grow over the time. This fund can be established within the next 18 months using that variable income that you expressed you wanted to dedicate to, such as Mark's parents' gifting and Jeffrey's bonus. If you use that income, you can create this fund in a very decent amount of time. The last goal we're going to discuss is your goal to create your savings for your home improvement fund. We do recommend that you wait to create this fund while you are paying off your debts and creating that the emergency fund. And after you've created both of those, paid your debts and created that fund, we recommend starting with this fund. Save $1,000 per month for 20 months or $500 a month for 40 months. And this is lower payments over a longer period of time to allow you to live comfortably, similar to your current lifestyle, and just enjoy your life as you are now. Now, Jamie is going to discuss your retirement plan with you. Jamie?
Thank you, Rochelle. The goal of retirement planning is to achieve a level of financial stability that will allow you to maintain the lifestyle you would like after you leave the workforce. This planning will not only allow you to live comfortably, but allow you to spend your time as you desire, whether that's traveling or spending time with friends and family. There are many, many different ways to save for retirement, and we would like to work with you to find the way that best suits your financial needs. The first step in planning for retirement is to identify your goals. Through our previous meetings, you mentioned that you would both like to retire at the same time, when Mark is 65 and Jeffrey is 68. In creating the plan, we made a few assumptions. First, we assumed that Mark would live to be 86 years old and that Jeffrey would live to be 89. We are anticipating inflation to be 3% per year. During our previous meetings, you've mentioned to us that you believe you will need 80% of your current after-tax income to fund your retirement. Having 23 years until your goal retirement is something we also assumed. We also believe you both will receive Social Security retirement benefits, and that within 3 years you will be debt-free and contributing to your retirement savings. You currently have just over $340,000 saved for retirement, and this is an amazing accomplishment that you should be very proud of. To determine how much money you will need to fund your retirement, we use the capital depletion method. This method assumes that throughout retirement, you will use all of your available resources to fund your retirement. If you implement our investing and savings suggestions, we believe you'll have just over $3.6 million saved for retirement at the time you retire. Through our previous meetings, you have also mentioned that Mark will be receiving a $1 million inheritance at the time of his retirement. We have estimated the value of your Social Security benefits at the time of your retirement to be just over $350,000 for each of you. Combining all of these sources, you will have just over $5.3 million to fund your retirement. This is above the $5 million estimate. We believe that you will be able to retire at your target date if you implement our suggestions. Some of the suggestions we have for you is for you, Mark, to consolidate your 2 individual investment accounts into one account specifically dedicated to retirement. We also recommend that you both reallocate your portfolios to reduce your risk exposure and increase your return. We also recommend that you contribute to your retirement savings annually. It is important to note that for Mark's SEP IRA, the maximum allowable contribution for this year is $51,000. This amount is indexed, so it will change each year. We also suggest reconsidering your retirement living expense. 80% seems like a good estimate, but you need to consider your tax liability even though you're no longer working. We suggest consulting with a certified public accountant about this estimate. We know a great CPA that we can recommend to you. Included in your plan are the suggested reallocations for each of your accounts. For Mark's retirement account, as you can see, you currently have 2 separate accounts. We would like to see this in one account divided between stock and bond mutual funds according to your risk tolerance. We have specific funds picked out for you listed in your plan. Some of the things we looked for in determining these funds were at least 3-star rated with managers that had been there at least 5 years. For Mark's SEP IRA, we really didn't change the allocation too much. The current position has 16% in cash. We would like to see that invested in a bond fund, which would be stable and conservative, but would hopefully outpace inflation in the long term. In Jeffrey's retirement account, we have also reallocated it similar to Mark's with a mix of stock and bond mutual funds according to your risk tolerance. I'm going to turn it over to Sam to talk to you about your income taxes.
Thank you, Jamie. Before I get started, Mark and Jeffrey, I just want to express our confidence in your ability to reach these goals. I know we've talked about a lot of things, but we feel that if you implement some of the recommendations and maybe some of your own, that you feel that you really can meet your goals, which is what we're all hoping for. So when we talk about income tax planning, especially this year, we're going to talk very broadly about what has changed politically and how that impacts your income tax. And we're also going to talk very specifically about the changes that can take place because of the recent ruling. So it's important to kind of keep things in perspective of what you were working with when you filed your taxes and when you brought them to us. So in 2012, the federal government did not recognize same-sex marriage. And so what that required you to do is, because you reside in a state that does recognize same-sex marriage, it required you to file a hypothetical, essentially, federal tax return using the married filing jointly tax information. And then you ported that information over to New York State and then submitted that. But then what you had to do is with your federal, you each had to file separately and using the single status. So that has changed and provides a lot of opportunities for you. And something else that is unique to you is that New York City tax is also something that we have to take into account when filing your taxes. So in 2013, just this last July, the Defense of Marriage Act was struck down by the Supreme Court, and there are numerous implications, and I think we're still going to see exactly what that means. But specifically for tax, it means that you are now allowed to use the married filing jointly filing status. And specifically, we're going to talk about that in 2012 terms. So looking back, the federal government is allowing you to amend your 2012 tax return and changing your filing status to married filing jointly. So that's a definite opportunity. And as we were kind of looking at the numbers of your tax return, we've determined that there's a lot of areas that could be improved, particularly talking about itemized deductions. We know there are business expenses, and you have a mortgage, but there just wasn't a lot of information provided to us. So what we recommend is in the next few weeks, kind of collect those receipts from 2012 about the business, bring your loan or your mortgage information to us, any health or medical or dental expenses that might be relevant, And then, of course, we have your state income tax information that we can take and itemize that as well. So moving forward, what we'd like to do is, Mark, we know that you're self-employed, and that's great that you kind of have the personality for that. I'm not sure that I do. But you're required to make quarterly income tax payments, and what we'd like you to do is to increase those, because as you'll see a little bit later, and as you know and you're probably feeling right now, you had a pretty sizable income tax liability at the end of the year, and the CPA that we like to work with can work with us in tandem to make sure that you do that optimally. And then also, one thing we'd like to see you adjust is go to the Human Resources departments of where you respectively work and file a W-4 form to adjust those withholdings to make sure that there's an adequate amount being withheld. So again, at the end of the year, you don't have this large tax bill. So what I've created here is kind of 2012 and just how things will change. And this is simply just highlighting the change in the filing status. The other ones we'll be able to compute in the next few weeks as we work together. But simply just by filing as married filing jointly, you save about $2,000. And where that savings comes in is when you're filing singly, you were in a higher tax bracket, and then when you filed mailing filing jointly, you went from 33% to a 28% tax bracket. So that just saved you quite a bit of money right off the bat. And then I highlighted the standard deduction because that's something that can change. As we itemize, you might be able to save quite a bit more money, and being in a lower tax bracket, see a higher relative savings. So there's a couple obstacles that we see relative to your situation. One is that if you were to move from New York to a state that didn't recognize same-sex marriage, that would require you to file your state tax returns as single, which is essentially the opposite of the issue that we just addressed. And so if at all possible, stay in the state that you love, New York, and where you work, and that you'll be able to avoid that. And one other thing that I want to mention is we ran the numbers for the alternative minimum tax, and thankfully this last year you don't have to worry about that because that would negate a lot of the benefits of the itemized deduction. But you were very close, so that's something that we'll want to monitor in the future to make sure that you're staying unqualified for the alternative minimum tax. So switching kind of back to a summary of what we've discussed, we have, and this information has been provided with your financial plan because we know we've covered quite a bit. But on your budget, of course, your focus on being debt-free is really important, and we want you to pay down your debt while simultaneously building that emergency fund, because you really have to do both, and you can't choose between one or the other. And then after those things are established, starting your home improvement fund, because that's kind of more of a luxury. And then for retirement, we want you to contribute to your retirement accounts, and we suggest making the changes that Jamie recommended, and we'll coordinate with your investment advisor to sort of make those changes. And then for income tax, we recommend you amending your 2012 using the married filing jointly status, and then itemizing those deductions. And then finally, going to the Human Resource Department and filing a W-4 and getting all that adjusted. So on the right, we have this checklist created for you, and we know it's quite a bit, but we're going to do this together. We're going to help you make sure that you meet your goals and get all these things knocked out. So hopefully in the next few weeks, we'll be able to do that according to your schedule. But after that, we plan on just hoping to see you about every 4 months to make sure things are on target. So Mark and Jeffrey, it's really been a pleasure to work with you, and we're grateful for your business and grateful that you've decided to come to Bluemont Financial. If you have any questions specifically about what we talked about, we have some more specific numbers that on the screen might have been just gobbledygook, but in your plan they'll be really helpful to you. So come talk to us and we can address any questions that you have. Thank you.
Yes, thank you.
For those of you who were not here for the first round, the judges will confer for a few minutes. We give them about 5 minutes or so to get their notes together, and then they will give some comments to the students. What else? What did I say? As I said, we're running a little bit early, which is great, but as people know, we are going to be fair. Everybody's going to be allotted the 5 minutes to set up and the 20 minutes to present, no matter what time or how quickly you're going. And if there was a school, for any reason,
So I'll start with just some sort of general thoughts and then specific feedback for each of you. So I really enjoyed the presentation itself. I thought the way you laid it out, it was just really slick and made things really easy for the clients to understand, or us as the clients to understand. I also appreciated how you really broke things down into little small sections, little bites of information that made it easier to sort of digest one by one. The one big opportunity across the board for you was to check in with us as the clients to make sure we really understood. So there were times when we went through a lot of information quickly. It's really helpful when meeting with clients just to stop, pause, say, do you understand? Do you have any questions? And proceed forward. Otherwise, you may lose the clients. So, Rochelle, we'll start with you. So you walked us through sort of the current situation. I really appreciated starting with that and emphasizing the importance of cash flow. For a client like this, cash flow is king, and making sure they have a good sense of where money is going is going to be the most important piece. So I really also appreciated your coverage of net worth and how this is sort of a benchmark for how you're going to judge our work together. A few things to consider. You went through a lot of information very quick. Your pace was very quick. An opportunity just to slow down a little bit to make sure we're able to understand. The other thing to consider is using words like emergency fund ratio and debt ratio can be sort of confusing. Ratio can be an intimidating term to someone who isn't numbers focused. So trying to think about how to, instead of things like emergency fund ratio, say cash reserve. And just using maybe a little bit more friendly language might be helpful. Jamie, I thought your pace and how you sort of went through things was great. Your presentation style, I really enjoyed. I appreciated it. I also appreciated how you used numbers so that we understood exactly what things were going to look like for our retirement plan. One big piece of feedback I have for you is you showed us where we'd end up if we took your recommendations. I might start with where you are currently. So it would be helpful to sort of juxtapose, here's what would happen if you kept along the path you're going, and then with some of our recommendations, here's what it would look like, to really drive home the point of making sure we actually follow through on our recommendations and understanding where the gaps are. So Sam, you closed things out. I also appreciated your pace and sort of you had a little more casual approach, which I appreciated in the language you use and how you approach things. The only piece to be careful of is being casual with clients can help, but just there's a fine line, kind of with professionalism, right? A couple great things you did. You mentioned that the risk of moving, which I thought was really an interesting risk. What I might have gone a step further and said is, well, there's a couple states around you. There's Connecticut, there's New Jersey. What are the rules like there? What would happen if you were to move there? You did a great job with the summary. You kept it very simple. So having, I think there were maybe 4 basic steps and then a couple sub-steps that made it really simple for me as a client to know what to actually go do and didn't make it intimidating. The only real negative piece, aside from being careful with the casual languages, is you explained what had happened with DOMA. I got a little confused. So just being able to clearly articulate exactly what things looked like would have been helpful.
I really liked the presentation and the use of Prezi. I think that really helped you to be able to drill down into some of the fine-tuned points within it and kind of start off with that broad overview, but really drill down. Rochelle, the financial statements was great. And, I thought it was a good explanation of a lot of the numbers, the ratios, even though, ratio, but still I thought you explained it well. What I probably would have liked to see was, we tell people all the time to pay off credit cards, to pay off debt, maybe show them an example. And because to me that gets more to the home of, if I pay $500 here, I can have this one paid off within the 2 years and then put that money here. So maybe just an example would have been helpful. And then, showing the same thing with the savings, just kind of breaking it down to more examples, but applicable to them. Jamie, I thought that was a good example with diversification, as far as where you broke down where they were invested currently and how your recommendations as far as the pie charts looked within that. So I really did like the visual examples within that. And then Samuel, I thought that was a good example giving, amending the 2012 taxes. They maybe could look at going back, but then sometimes, it's not very helpful too. So kind of maybe discussing the positive and negatives of looking at it both ways. And I think that covered everything, building on the other.
I think they've both touched on the points that I made, with the exception of it's really good to have a good, here's what we're talking about, and here's where we are, and here's why we're going to look at these ratios, for example. So I like the explanation of the ratios, but who decided on these numbers and why? Who says 10% of my income should be going toward debt? So giving that rationale, and then as David mentioned, I'm so sorry, getting the buy-in from the client, because it's great to give a bunch of recommendations, but if you're not eliciting that feedback and making sure that they're motivated to do it, it's probably not going to go anywhere. But overall, really good job, guys.
The next school up will be, Virginia Tech. I think I have that right. Yeah. Again, for students from competing schools, all we ask is that when you come and watch another team, that you keep the comments in New York State. The students were presented the plan prior to the Supreme Court decisions, and so have had to adjust with those decisions in June for their plans as well. What we have from us now, we have Virginia Tech, and we have Brittany Clifton, I would guess that one, Carter Ellis, and Chad Thompson.
Hi Mark, hi Jeffrey, how are y'all doing this afternoon? It's great to have you back in the office with us. I see you brought your plans with you, that's great. You might need them sometime during our meeting this morning. So at our last meeting, we talked a little bit about some tax planning strategies, your insurance needs, and we touched a little on adoption and surrogacy, and I know you're both really excited about that. So I sent an email last week to see if there's anything you really wanted to discuss at our meeting this afternoon. And Mark, you said that you were really interested in learning a little bit more about the DOMA ruling and how it's going to affect you and Jeffrey this year. So we wanted to start today by talking about the IRS ruling, and then I wanted to talk a little bit about your debt and how it's going, and some recommendations we had for you. Then Chad will talk about your retirement planning, and finally Carter will talk a little bit about your investments. So this past June, the Supreme Court overturned part of the Defense of Marriage Act, declaring it unconstitutional. Now the federal government has to look to the states to see if a couple is legally married on the federal level or not. So if a same-sex couple is married in one of the 12 states or the District of Columbia that have legalized same-sex marriage, then they will have to be recognized as married on the federal level as well. And this really comes into play with federal income taxes. So before the DOMA ruling, you both filed your taxes as single, your federal taxes, even though you were legally married in the state of New York. Now, after the ruling, you'll have to file your federal taxes as married, so either married filing jointly or married filing separately, even though you, and this is really important this year because of all the changes, and as great as it is that you will now file as a married couple, married couples do pay higher tax rates at lower amounts of income than those who file single do, which some call the marriage penalty. And this year, the marriage penalty is going to be even more important because of 3 changes to tax law that are scheduled to go into effect. The first of these is the Patient Protection and Affordable Care Act. And under this, taxpayers whose adjusted gross income is over a threshold will have to pay an extra 4.7% tax between Medicare and their investment income. You can see the thresholds for those filing single and filing married filing jointly on the screen. And before the DOMA ruling, you would not have been affected because your separate AGIs were below the threshold. But now that you are considered married on the federal level as well, your AGI is over the $250,000 threshold, so you will be affected by this extra tax this year. Also, PEP and Ps are scheduled to go into effect this year due to last year's fiscal cliff deal. PEP is the personal exemption phase-out, which means that taxpayers who have an adjusted gross income over the threshold can start to lose their personal exemption benefits. And Ps is a cap on itemized deductions, where up to 80% of the taxpayer's itemized deductions can be reduced if their AGI is over the threshold. And you can see the thresholds for those filing married, filing jointly on the screen, and I'm sure you've both noticed that your AGI is over these thresholds, so you will be affected. Also, please keep in mind that we are not tax professionals, so we recommend that you see your CPA before implementing any of the tax recommendations we make for you throughout this presentation. So if there aren't any other questions about your taxes or the DOMA ruling or anything else I've mentioned thus far, then I wanted to talk a little bit about your debt and some recommendations we had for you. You can see your current credit card balances and the interest rates that apply to them on the screen. You also have a $40,000 loan on your life insurance policy. A while ago, you mentioned to us that, Jeffrey, you'll be receiving your $27,000 bonus at the end of this month. And Mark, your parents will be giving the both of you a joint gift of $50,000 this year as well. Mark, we do recommend that we talk to your parents a little bit and remind them that there is a $14,000 limit on taxable gifts per year, per person. So we do recommend that each of them give each of you an equal gift of $12,500 this year, so they won't have to pay any extra taxes on this gift. So our first recommendation as far as your debt goes would be to pay off your credit card balances right away with all of Jeffrey's bonus and part of your retirement mark. So this will give you an extra $2,500 or so a month that you won't be paying on your credit cards that you can save towards your other goals. And as we mentioned in our last meeting about insurance, we recommend that you cash in your current life insurance policy, which would take care of your $40,000 loan and still leave you with about $10,400 or so after doing that. As we discussed, the premiums that you paid on this policy were higher than the cash value that was generated, so there won't be any capital gains or tax implications of this decision. And you might be wondering why we don't think it would be best to use your bonus and the gift to save for your retirement instead of paying off your credit cards. Well, the interest rates on your credit cards are between 13% and 18% among the three cards. And as Chad's going to mention to you in a moment, the interest that you will save from paying off these credit cards right now is going to be much higher than the projected after-tax returns of your retirement accounts. So if there aren't any questions about these debt recommendations or anything I've mentioned so far, then Chad will talk to you a little bit about your retirement planning.
Thank you, Brittany. Now we know that one of your most important objectives is how to plan for a comfortable retirement. We'll now discuss our analysis of how we're going to try and help you guys reach that goal. So as we've discussed in the last couple of weeks about your retirement goals, Mark, you're planning on retiring at age 65, and Jeffrey, you're planning on retiring at age 68. We're also planning on trying to replace 80% of your current income, pre-retirement income, throughout the retirement cycle. So here are a few assumptions that are going to lay the groundwork for our analysis. As we've discussed in the past few weeks about your family's health history, we've came up with a more accurate life expectancy for the both of you. Mark, we're projecting a life expectancy of 86, and Jeffrey, we're projecting a life expectancy of 89 for you. Also, we know that your income isn't going to stay the same forever, so we decided to project that in the future using a growth rate of 3.5%, which we based off our projection of inflation. Also, we're going to utilize a rate of return of 9% on your retirement assets, which Carter will go into more detail in later on in the presentation. And utilizing all this data, we're projecting that you're going to need to save about $40,500 per year in order to reach your retirement goals. So I just want to describe the three different types of methods you can use to save for your retirement, or to calculate your retirement needs, rather. They're the capital depletion method, the capital preservation method, and the purchasing power method. The capital depletion method is going to be the least expensive method to fund, but it's also going to leave you with a balance of zero at the time of your death, as you can see from the blue bar here. So you're not going to be able to leave an inheritance of any kind if you do, or if what we projected is correct here. Also, with the capital preservation method, it's a little bit more expensive to fund, but it's going to leave you with a little bit of a balance at the time of your death, as you can see with the green bar here. And that's going to leave you with a little bit of money to leave as an inheritance if you so choose. Then the purchasing power method, represented in red, is the most expensive method to fund. but it's also going to leave you with the greatest balance at the time of your death, because now we're calculating it using the same way we calculate the capital preservation, but now we're factoring in inflation as well, which means when you leave an inheritance to your heirs, they won't lose any purchasing power. So, I mean, I know I've explained these pretty fast. Are there any questions before I move on with the presentation? No? Okay, well, here's a chart of our joint annual savings goals that we've projected for you. As you can see, this familiar number of $40,500 is the number we projected if you retire in the year you're planning on retiring at, utilizing the capital depletion method. We believe you both have the capital to reach this, or to utilize this approach, and as you'll see in the next slide, we'll show you a picture of what that's going to look like in the future. So by now, you've probably noticed the other two boxes that are also highlighted in yellow. And in the last meeting, you discussed the possibility of adopting a child. And here at Blue Ridge Wealth Management, we deal with many families with children. And the goals before and after you raise a child can be completely different. For example, after you have a child, you may want to leave an inheritance and totally switch up the amount you're going to fund for your retirement. And why I show you this, if you look back at the highlighted boxes, is you can possibly utilize the capital preservation or the purchasing power method if you retire 2 years after the target year or 4 years after the target year without having to significantly alter your lifestyle in any way. So you actually notice that these numbers are actually a little bit smaller and you have to save a little bit less than we're projecting you to save now. So that's something to think about if you do decide to adopt a child and leave an inheritance. So are there any questions about how I got any of these numbers up here? Any more questions about the 3 different methods? Okay, well, here's a picture of what your retirement assets are going to look like along with the distributions. So this blue line graph is pretty much what your retirement assets are going to look like from now until the time of your death. You've done a great job saving so far. As you can see, you've accumulated over $300,000 in retirement assets. But what I want to key on here is at retirement, I just wanted you to recall, if you want to look in the plan under the retirement section, we're recommending that you utilize the $1 million inheritance you're receiving from Mark's parents at the time of retirement and invest that in some non-qualified mutual fund accounts. So now I want to focus in on the withdrawals a little bit. So are you guys familiar with RMDs or required minimum distributions? No? Well, what that pretty much is basically at age 70 and a half, you're required to distribute a minimum amount out of your qualified accounts for the most part. But in your current situation, the 2 qualified accounts you own do qualify for the RMDs, so you are going to have to take out RMDs. What that's going to allow us to do is this year before you reach the age you qualify for RMDs, you can completely withdraw, as you'll notice from the green bar, out of the non-qualified accounts, which will be taxed at the capital gains rate rather than your current income tax rate. And we know you guys are always talking about how tax savings are very important to you, which is why we're recommending that. So from then on, you'll notice how we've broken it down into the different colors: Social Security, non-qualified, your SEP, your traditional IRA, and so on, up until the final age of your retirement, represented by that orange Roth bar, which is where we're going to make our final recommendation. Now, Jeffrey, if you remember from the plan, we previously recommended that you roll over your 401k from your previous employer into a traditional IRA. Well, now we're going to go a step further and recommend that you convert that traditional IRA into a Roth IRA. Now, that's going to be taxed at your income tax rate, but what it's going to do is allow us, if you invest in it right now, allow the earnings to grow tax-free for 40 plus years, as you see, until the final age of retirement. And not only that, but it's also going to allow us to withdraw that money completely tax-free. And once again, you guys put a huge emphasis on tax savings, so that's why we're going to recommend that. So one more thing before we continue to the recommendations. This dip right here, you may have noticed, that is because due to a less active lifestyle and decreased expenses, we're projecting that your needs will go down approximately 10%, which is normal around that age. around age 84. So that's why we did that. Is there any questions about this? I know I've been going through this pretty fast. This can get a little complicated. You sure? No? Okay. Well, here are our recommendations. You can follow along the plan under the summary at the end of the chapter, retirement chapter, if you wish. Mark, we're recommending you contribute $24,000 a year to your SEP, and we're also recommending you roll over your 401k from your previous employer into your SEP. Jeffrey, we're recommending that you contribute $5,500 a year to a traditional IRA, and like I just mentioned before, we're recommending you roll over your 401k from your previous employer into a separate traditional IRA in order to maintain the rollover status. We're also going to recommend that you convert that traditional IRA into the Roth, like I just said, and we're also going to recommend that you contribute $11,000 per year to the non-qualified mutual funds accounts. So if there aren't any questions, that concludes the retirement analysis. I'm going to ask Carter to come up here and explain a little bit about your investment plan.
All right. Thank you, Chad. Now that he's given you an overview of the direction of your retirement accounts, we'll cover what kind of investment allocation that's needed to reach your goals. And Mark, we can start with your retirement assets. We're really glad to see that you've done a great job of saving so far. From our questionnaire that we sent you, we know that you would like to see investment growth while preserving capital with low volatility and protecting your portfolio from inflation. And we also know that you'd like to see a minimum 7% rate of return for the long term. So here we've analyzed Mark's 401k and SEP IRA investments together since we recommended that you combine them soon. Which brings me to your allocation. You're heavily invested in fixed income securities and cash with only 15% of your money in the stock market. And here you have the bond funds in blue, and these three are the stock funds in red. You've done a great job at picking the funds, but it just happens that this is a very conservative allocation for you since we know that you have a greater risk tolerance than this. However, over the last 10 years, this allocation has worked out rather well for you as bonds have done uncharacteristically well. You've maintained a return of almost 7% with a standard deviation of only 6%. And standard deviation is our preferred measure of risk because it measures risk on an absolute basis as opposed to the more popular beta, which measures risk relative to the market. So what a 6% standard deviation really means is that with your mean return of 7%, in any given year, there's only about a 1 in 6 chance that you'll have a negative return. And by looking at your ideal portfolio on the questionnaire, we know this is the kind of volatility that you're most comfortable with, but in order to acquire those returns that you'll need, we recommend that you increase your exposure to risk. But we also realize that you're willing to take on a little more risk to acquire those returns. So let's talk about what your portfolio should look like going forward. We recommend that you reallocate so that you have about 3/4 of your money in equities and the rest in bonds and cash. In the past, stocks have performed better than bonds on average, and we believe that you should increase your exposure to these risky assets. As you can see, we kept the funds the same. Now that all your money will be in the SEP IRA, you're not constrained to the investments in your 401k, but we like the funds that you're invested in, and we understand that you're familiar with them, so we decided to keep them the same. As Chad mentioned earlier, you'll need a 9% rate of return to reach your retirement goals. And with this allocation, we project that you can reach this working with all the other recommendations in our plan. This will require you to take on more risk as this portfolio has a standard deviation of 17%, which means that in any given year, you'll have about a 1 in 6 chance of losing more than 8%. However, looking at the questionnaire again, we understand this matches with your risk tolerance. So now that I've showed you all these numbers and analysis, do you guys have any questions for me about any of this? Okay. Well, let's talk about how we'll get this done. Mark will help you roll over your 401k into the SEP IRA, and then we can reallocate for you should you decide to accept this allocation and sign on as our clients. And in that case, we'll prepare an investment policy statement for you that lays out what I just described. And in the future, we'll watch your portfolio regularly to make sure it hasn't deviated from what we agree upon and that the investments don't lose their appeal. And here at Blue Ridge Wealth Management, we meet with clients at least annually to discuss rebalancing so we can plan on that, or if you ever have any questions in the meantime, of course you can ask us. And And as you get closer to retirement, we'll revisit your allocation and move you into a more conservative portfolio so that you can help preserve your capital and have a more fixed income stream. And Jeffrey, we have a similar allocation for you, and we can cover that when we get back from a break. I know we've been talking for a while, so if you don't have any more questions, we can take a short break and stretch our legs and come back.
Thank you. We will once again give our judges a few minutes to get their thoughts together. And then
Great job, guys. First of all, I want to say really good. I enjoyed so much the great personalization at the beginning, coming back in, recognizing that you do know us. We've already met and talked about a lot of things. I thought you did an excellent job recapping the goals, each of you, for each of your sections. But you also did a good job of recognizing where the clients may have expressed concern in certain areas, and particularly I want to point out where, oh shoot, Brittany? Yeah. Brittany, you obviously paid careful attention to the fact that the clients were sensitive about Mark's parents giving money to both of them and not just him, and you made a point to bring that into the conversation. You also all did a really good job giving the rationale behind your recommendations, not only the textbook rationale, but making it personal to the clients and why you were recommending what you did for them. I got a little, I guess maybe glazed over in the distribution phase because of my age as a client. I'm not quite ready to be thinking about the very last year in the distribution that I'm going to take out, so maybe a little less detail in that area. But again, I thought the explanations of the recommendations that you gave were very good, and I loved that you explained the assumptions. So many times we, as planners, know why we're recommending what we do and why we said you're going to live to age 86 or you're going to live to age 85 or whatever it is, but explaining that to the client is really good. The end was a little, the next steps, and I know you were limited in time and that you were saying we're going to come back and take a break, but maybe just a little more definition around who was going to be responsible for what and what the next steps are good for clients to know coming out of a conversation.
Hi guys. So I agree for the most part everything that's been said so far. I'll add a couple of extra pieces. So Brittany, I really appreciate your presentation style. I think you did a great job walking through a lot of information quickly, but also in a way that I understood what was going on. The way you worked through the marriage penalty is a perfect example of how to talk about potential drawbacks with what many people may view as a slam dunk sort of thing to do. There's actually some things to consider, which you did a great job of. One thing that maybe could have used a little bit more of that is the idea of cashing the VUL. That can be a little more complicated than, and there's certainly some pros and cons. It maybe would have been helpful to go into just quickly why you were thinking that and what some of the risks might be. For Chad and Carter, a couple things just to note. There was, from a presentation standpoint, there were a lot of ums and uhs as you went through things. Obviously, there's some nerves. It's a sort of a nervous thing that a lot of folks do. Something just to be very careful of. The other piece is a little thing that I learned early on in the business, which is using guys when you're talking to two clients actually shows a little bit of inexperience. I've always tried to use folks versus guys. I sort of had that drilled into me early on in the career, just to make sure that you're representing folks and making people feel a little more comfortable, not necessarily showing experience. The idea of distribution was I had the same struggle, that it got a little lengthy, but the concept that you were trying to sort of articulate is a very powerful one, which is waiting a year or two to retire can actually mean that's a big deal. So concept was really strong, maybe a little bit long on the explanation. For the investment plan, I think you did a great job, Carter, of walking through what standard deviation is and how that works and why you use that as a method. The one thing I would just caution you on is that's a big swing for that client in terms of the investments, and they might see some major swings over the next few years relative to what they've experienced. So just recognizing that, checking in to make sure that they understand. There could be some emotion in that, and making sure they're really truly comfortable with the recommendation.
I thought you all did a great job explaining the logic behind a lot of it, and pausing and asking for questions, and do you understand this, all of that kind of stuff. Let's see, Brittany, I thought you did a great job recommending the CPA, going over the credit card loan balances, including all the numbers, all of that kind of stuff. Let's see, Chad with the retirement planning. I really like that you discussed how the goals might change if they bring a child into the picture. So that was, a unique aspect. I did hear a little bit of jargon with the capital depletion and preservation and purchasing power. I might have liked to have that better explained to me as a client, so I could understand, exactly which way I might want to go with a little more detail, and then a little more detail about why some of the specific numbers, how you calculated some of that within the retirement planning. And then as far as the investment plan, again, just maybe a little more detail, because I know we were, taking a break, coming back to it, but maybe just a little more about, okay, this sounds great, what do I do now? Who can help me with this?
I have to be careful not to say Okay, we will. The next team up will be the next team up will be William Paterson. We will then break for lunch. Between CFP Board, Ameriprise, and FPA. We have one judge representing each of the partners, Valerie Porter is representing. We have Daniel DeVizio, Robert Scheiss, I hope I pronounced that right, and Giuseppe. Boy, my God. It had to be Jersey Group that's giving these names.
I'm just going to hit the start button, and then they're going to start us. We're going to walk over. Okay. Hello? All right. We're good? All right, we can start. Morning, gentlemen. How are you today? Let's go there. Now, I realize we've only got about 20 minutes to give the presentation today, so we're only going to do 3 aspects of the plan. We're going to start off with cash management, which is going to be presented by Giuseppe. I'm going to follow up with retirement planning, and then Brian's going to finish it up with investment analysis. We met back with you in April to go over the original plan, but there's been a couple changes since then, namely the repeal of DOMA. Because of the repeal of DOMA, we're going to have to go over a couple changes that are in these 2 sections, the cash management and the retirement planning. And with that said, Giuseppe is going to start with cash management.
Thank you, Dan.
Sure.
So on this chart, you have your net worth, and you have your on-hand assets and your investment assets that you will be able to live off of. Your personal property assets, which include your weekend home and personal possessions, and your liabilities, which include your short-term and long-term debt. Your net worth is a little over $430,000, which is a great way for you to continue your style of living. Your cash flows consist of, by following our plan, monthly expenses, which I will go over shortly, intermediate goals, which includes a possible adoption or surrogacy, vacation funding, and rental properties for the future. And the ultimate goal of retirement, which Dan will discuss in more depth. Now that you can file married filing jointly, you could save nearly $9,000, which can go either towards intermediate goals or retirement, but please talk to a tax professional before doing so. This example really covers your needs, wishes, and wants. You really have 3 options when keeping your lifestyle expenditures during retirement. First option is you can invest more to earn more, which may not make sense for you, and Brian will discuss that in a little bit. Secondly, you can work later on in your life, which may be too risky because we cannot control when you retire due to health issues or the job market. Or 3, which we are going to focus on, is cutting costs now so you can spend more later. Looking at your cash flows, you could save a few $100s in the bills and utilities and apartment-related expenses. You could rent a slightly less expensive apartment or become more energy efficient. But where you could save a few $1,000s is the discretionary category, which includes things like dining out, pet care, and health club memberships. We won't tell you where to cut costs, but we do advise allocating the $5,500 to these areas and not going over that. This will be a great way for you to keep these expenditures when you stop working. Had you continued to pay $2,550 per month, it would have taken you 2 years to pay off this credit card debt. By following our implemented plan over the last few months and increasing your cash flows from received rental income and Jeff's work bonus, you have saved yourself nearly $9,000 in interest and further increased your cash flows. So congratulations on taking these steps and eliminating this credit card debt. We start saving for your rainy day fund now. You have $3,800 cash on hand that you will invest in a money market account, which will give you the flexibility of a checkings account and the interest rates of a savings account. You'll invest nearly $5,000 monthly, and we won't touch your initial investment of $13,500. So it should fully be funded by next September, and this will benefit you because you want to maintain a sufficient amount of funds in case of a possible adoption or surrogacy, or if an unforeseen accident occurs. This is a snowball effect timeline, which really gives you target dates that you will be able to reach. So at the end of this year, you'll start saving for your retirement by investing nearly $27,000 yearly. By 2022, as cash flows continue to come in, you can purchase your first rental property. And by 2024, you will have saved nearly $250,000, and you can purchase your second rental property, satisfying that goal. Finally, by 2028, you will have paid off your mortgage, and you will fully be able to move into your weekend home and solely focus on funding your retirement. By following our recommendations, you have paid off your credit card debt. Now you have to reduce your lifestyle expenditures to save for future funds and start saving for your rainy day fund over the next 9 months. And with that said, Mark and Jeff, if you don't have any questions, Dan will present your retirement planning.
Thank you, Giuseppe. Gentlemen, before we get into talking about your retirement plan, first let's go over the aspects of the repeal of DOMA and how that's affected you financially. As Giuseppe has already mentioned, your federal income taxes that you file each year, you now have the option of married filing jointly or married filing separately. Be careful though, because you no longer have the option of filing single. In our original plan, we had discussed being careful on how much you spend on each other each year, because you could possibly trigger gift tax. If either of you had spent more than $14,000 on the other during the year, you'd run into gift taxes. That's no longer a problem with the repeal of DOMA. You're now treated the same as all other marriages. Congratulations on that. That's a big deal. Also, this allows Social Security claiming strategies. What you have available to you at the moment is what we've got represented in this chart. Currently, and before you had this option available as well, if you were to just claim Social Security benefits at retirement, Jeff, you'd be looking at about $16,400. Mark, you'd be looking at about $13,200 if you were to claim those benefits at retirement. Now, this is at 50% of what our planner estimates are, which is what you requested in your questionnaire when we first had met you. These amounts are adjusted for inflation going forward. However, we don't show that in this chart just for demonstration purposes, so you can get a fair comparison of the numbers. Now, these numbers, this is where it gets really exciting. This is where you can do a strategy called file and suspend. The way it works is simply this. Jeff, when you retire, you're going to file for your benefits, but you're not going to collect them. You're going to suspend those benefits. The reason being is you want, for the 2 years, for 68 and 69, you want at age 70 to get the maximum amount of Social Security benefits. That's going to get you about $18,900 as opposed to the $16,400. It's about a $2,400, $2,500 increase every single year going forward for the rest of your life. What that's going to do by filing and then suspending is it's going to allow Mark to claim spousal benefits. By Mark being able to claim spousal benefits, you're going to be able to leave your Social Security benefits out there to get to their maximum amount at age 70. So you'll be collecting about $7,600 a year during the first 5 years. When you reach age 70, you're going to stop collecting spousal benefits and instead start claiming your own Social Security benefits. We estimate that to be about $17,900, which is up from your $13,200, so you're getting about $4,700 extra. Between the two of you, you're getting almost $7,000 extra every single year for the rest of your life. The other benefit of doing this is, Jeff, by you suspending your benefits further, were Mark to outlive Jeff, Mark would be able to collect the spousal benefits, would be able to collect Jeff's benefits of the $18,900. So really, Jeff, you're maximizing the amount that Mark would also be able to get should you pass before he does. Now, this also has the downside. At the beginning, you're going to be collecting less money, so you're going to be using more of your investment savings. So you really want to look at, when does this strategy really make sense? It makes sense. It breaks even at about the 12-year mark. So 12 years into your retirement, when Mark, you're 77, Jeff, you're 80, that's when this strategy really starts to pay off. Going forward, if you were to live to your actuarial estimated life expectancy, we estimate you'd be making about $65,000 extra over all the time. And this is free money that was not available to you before the repeal of DOMA. Now, your funds in retirement, at the moment, you've only got funds in traditional retirement accounts. So this is money that you put in before tax. So when you take it out later, it's going to be taxed. You also are going to have a brokerage account, which Brian is going to be discussing in a few moments. And also, you're going to have at retirement, Mark, your parents are going to be giving you, you're going to have about $1 million from inheritance at retirement. Is that still correct? Are we still okay with that assumption? Okay. So we want to introduce a third bucket of money for retirement, a Roth bucket of money. What this allows you to do is, we don't know where tax rates are going to be in the future. We assume they're going to be higher. We also don't know what tax bracket you're going to be falling in. So we want you to be able to, if you're getting close to a higher tax bracket, be able to use things like your Roth funds to keep you in the lower tax bracket. In order to fund this Roth money, currently you're making too much money to be able to directly contribute to Roth. So you have a couple options. Over the next 3 years, you could convert from your IRA and SEP funds. You can slowly convert those over to Roth funds. We would do that starting next year. The reason we would spread it over 3 years is to mitigate some of the tax consequences, because you'll be paying taxes on that money when you convert them over. And you also, also we would be able to recharacterize the money. We would use a strategy where we would be able to lock in the tax rate at the lowest possible value of those funds. Another option, Jeff, you had mentioned that your employer is going to be offering a 401k next year. We want you to inquire about if they're going to offer a Roth portion of that 401k. That benefits you in two ways. It contributes to two buckets at the same time. The employer portion would be going into the traditional retirement account bucket, whereas your contributions would be after tax. They'd be going to the Roth bucket. This is going to increase the amount that you can be saved into your Roth funds before retirement. This chart demonstrates what you would do with those three buckets here. You've got the top section here, which is your taxable accounts. That is the $1 million that you should be inheriting at retirement. That's also the brokerage accounts you should be setting up. That money is the money you're going to want to spend first in retirement. That's why it disappears so quickly. Because it doesn't have any tax advantages to keeping this account, you don't want this, of the three buckets, you'd prefer the Roth one to grow the most. So you'd want to draw from this one first. Then you've got the traditional accounts. That's your current money that you have now. We're going to be converting some of it over to Roth over the next 3 years. You're going to want to take from those funds second. The reason being, again, like I said, you want the Roth funds to be the ones growing the longest so you could take them out. They don't have any required minimum distributions or anything like that. Finally, retirement for our recommendations. We recommend that you save about $27,000 per year. The difference between the two strategies we introduced for Social Security benefits, it's only about a $700 difference in savings per year. So saving for $27,000 covers both plans. We also want you, as I mentioned before, to convert your existing IRA and SEP savings over the next 3 years, starting next year. And the reason we want you to start next year is because we want you to take right now you have previous employer 401ks. Those don't offer you any benefits right now. You have limited investment options. Instead, we suggest you do a trustee-to-trustee transfer to take those existing 401ks from your previous employers and roll them into IRA accounts now, so you have more control over them. Now, with that being said, if you don't have any questions, I'm going to let Brian take over with investment analysis. Thank you.
Thank you, Dan.
Mark and Jeff, now that Giuseppe has discussed how to achieve your short-term and intermediate-term goals utilizing a cash management strategy, and Dan has discussed how to achieve your long-term goals utilizing your retirement funding, I will now discuss how we can utilize your investment vehicles along with a structured investment philosophy to continue meeting your goals in the future. Generally, when investing, there's a trade-off between risk and reward. When you take low amounts of risk, you get low amounts of reward, and when you take higher amounts of risk, you get higher amounts of reward. However, not all risks are compensated with an adequate amount of reward relative to that risk. Therefore, there are two types of risk, uncompensated and compensated. We always want you to take on the risk that is compensated just so you can sleep a little better at night and so we can ensure that your goals are met in the future. When we look at the efficient frontier, which is a little bit more technical demonstration of this trade-off, you can see any portfolio on that efficient frontier line represents an efficient portfolio, meaning that the risk is compensated. For example, when you look at the asset allocation on the lower left, the 30% stock and 70% bond, that's a traditionally less risky portfolio, and you're compensated with a lesser amount of return. However, when you look at the portfolio with 100% stock, which is traditionally a very highly risky portfolio, you are compensated for that with a higher amount of reward. Any portfolio not on that efficient frontier line is an inefficient portfolio, meaning that not all the risk in that portfolio is compensated for, which we think is actually characteristic of your current portfolio, specifically in regard to Mark's stock incentive plan. With a value of over $18,000, this represents a significant portion of your portfolio, which is subject to company-specific risk, which can be diversified away from. Because this position is highly correlated to the success of your company, Mark, in the worst-case scenario, should your company go out of business, your portfolio will not only take a decline in value, but you'll also be losing a significant portion of your income. So we'd like you to mitigate that risk through the use of a protective option strategy, which will take place in 3 steps. First, you're going to want to buy put options to protect from any downward moves, and you're going to finance the buying of those put options through selling of out-of-the-money call options, which will also protect, lock in any gain. Also, once you do have gains, you're going to want to wait for over a year until they're considered long-term, at which time you can sell and diversify the position. Now we'll just assess your risk tolerance. At our first meeting on the risk tolerance questionnaire, you rated yourselves a 7 on a scale from 1 to 9, which we consider a moderate to moderately aggressive risk tolerance. With that in mind, your current asset allocation, which is displayed on the graph on the left, in that you have 14% in cash, which is a relatively high amount to be sitting in cash for your risk tolerance. You should have a little less than that, considerably less than that. Also, you have 58% in debt relative to 28% in equity, which again is a little bit skewed for your risk tolerance. You probably want more in equities. So we recommend the asset allocation on the right, which is overall, you can see from the chart, just more diversified. Within your domestic equities of 30%, there's an overall asset allocation in this portfolio of 70% stock, 30% bond. Within your domestic equities, we'd like you to invest in mid and large cap stocks, while we consider your rental properties to be like small cap stocks in your portfolio. Within the international equities, we'd like to see you invest in both developed and emerging markets. And as far as the bond portion of your portfolio goes, we'd like to see you invest in TIPS, which are inflation-protected treasury securities, as well as short-term and intermediate-term bonds, just to add some stability to your overall portfolio. And we'll get into specific security selection at our next meeting. As far as management of your portfolio goes, we'll implement an active rebalancing strategy, which means when the allocation of one asset class gets to be too high, stocks, for example, will compensate for that by buying more bonds, and vice versa. This creates an overall smoothing effect of returns in your portfolio and also forces you to sell high and buy low. Also, in terms of management, we'd like you to consider consolidating some of your current investment accounts, which are displayed in this graph here, this chart, specifically in regard to Jeffrey's 401k and his simple IRA, as Dan mentioned a little earlier. As far as recommendations go,
The proceeds of Mark's stock incentive plan will be funding a general brokerage account, and by the year 2024, you'll have considerable net cash flows to fund that account even further, at which time we'll like to implement some tax-efficient rebalancing and strategies, including waiting until gains are considered long-term and selling losses to offset the gains. Also at that time, we'd like to reallocate your total portfolio to include some municipal bonds, specifically New York City bonds in this case, which will be tax exempt for you on the federal, state, and city levels. Lastly, we'd just like you to consider executing the prescribed asset allocation we just went over, which will mitigate risk through diversification and keep you achieving that level of return relative to the risk you're taking. I think that about wraps up our time for you today. We'll schedule a meeting for next week to go over the rest of your financial plan. If anything changes until then, please let us know. And it's always a pleasure working with you. We hope you have a great rest of your day. Thank you.
Thank you, gentlemen.
No undue influence. So once again, we will give our judges a few minutes to get their thoughts together and their comments to the gentleman. We will then break for lunch.
Great job, first off. I think all you did a wonderful job. So I want to give you some sort of general thoughts and then specific feedback for each of you. So a couple great things I thought you did were you recognized through some of your illustrations and graphs that some people learn by listening, other people learn by seeing. So you gave a lot of visual representations of concepts that I think could be really helpful for folks that learn that way. And I think that showed a little bit of creativity in how you're thinking about this and demonstrating some of the concepts, which was a really great job. The one sort of general theme across the board that I would think a little bit harder about is you talked a lot about future concepts, which is valuable, but for somebody of this age, there's probably more immediate needs that need to be met and maybe a little more time spent on things that are going to happen today versus things that are going to happen in the future. So Giuseppe, we'll start with your piece. You used a couple of really neat phrases, and I tried to write them down, and I'm not sure I caught them correctly, but around cash flow specifically, cut costs now to spend more later, like those sort of buzzwordy type phrases are actually really helpful because they certainly stuck with me. They stick with clients. They sort of understand why we're doing what we're doing. How you went through and talked about the opportunity fund, both as a thing to hedge risk, but also an opportunity for things like adoption, that was very helpful. And I like the snowball illustration that just helped me visualize what you were talking about. You do have an opportunity, specifically with things like net worth, to address the number. Is it good? Is it bad? What does that mean? So stating what's happening is the first step, and then stating your sort of professional observations is, I think, really helpful. Daniel, I loved your presentation style. You had a ton of confidence. So and confidence is important. So as the professional and the financial planner, I believe that you know exactly what you're doing, which came across in your presentation, which I appreciated. As I mentioned, we spent a lot of time on the file and suspend idea, which is a long ways off. Great idea, but probably could have spent a little less time there. That being said, things like you talking about the different buckets with raw conversion, that's actually one that is immediate opportunity for this client, and I think did a great job explaining how that works. Brian, so you used a whole bunch of you used the risk-reward graph, efficient frontier, correlation, all things that helped me understand, or it started the path of helping me understand how to manage how managing the portfolio is going to look. Probably could have spent a little more time just really, truly explaining in layman's terms what we're looking at. So you used the word compensated for risk. That could be a confusing term because compensation for most folks is not the way you were addressing compensation. I also think you did a great job recognizing the issues of the stock incentive plan and talking about risk tolerance, which is obviously really important. Again, the one little bit of feedback at the end is, you talked a lot about things that we're going to do in 2024, and it could be confusing as to what is a future recommendation and what am I supposed to do today.
I think y'all did a great job overall. Just a few kind of key points. Maybe ask more, do you understand? You know, ask for questions. And I know it's kind of awkward in this setting, but just kind of pausing. You all went through it very quickly, which I know you only got the 20 minutes too, but maybe just kind of slowing it down and, you know, pausing a little bit more. Giuseppe, I like that you recommended the CPA and that you brought in some of that, and then maybe just explaining some of the meaning, like David had touched on, beside, you know, some of the concepts and stuff that you were talking about. And Daniel, I loved the claim and suspend with Social Security. I do a lot with Social Security work, and I know it's in the future, David, but I don't think we give enough emphasis to that sometimes and the different opportunities that people have. And it can really pay off if you know the different options behind some of that. And I thought you did a really good job explaining the logic with that. There was a little bit of jargon that I did pick up kind of throughout. For example, with yours, trustee to trustee transfers. Some people might not understand exactly what that means, and if you could bring in a little more specifics behind that. Brian, I like that you discussed the stock incentive plan as being a risk. You know, that was a really key point within that. When you look at the asset allocations, you know, making sure you're using the same language between the different charts would be helpful, because I saw, you know, debt was a really big part that I have right now, but I didn't see debt at all in the other one unless I know for sure, you know, a bond's a debt. So, you know, making sure people understand that how it looks different, or explaining it. I think that's all I've got.
The only other thing that I would add to what they have said, and I agree with everything that has been said so far, is being on the receiving end of being told you need to spend less. We want you to open a brokerage account doesn't always sit well. So when you're making recommendations, maybe softening up the language a little bit. Consider opening a brokerage account to do this. It might benefit you, and in the discussion about risk, Brian, you said if you take more risk, you will have better return. That's not necessarily true. So again, it's just kind of couching and using language. You have the potential for greater return. You have to be careful with cut and dries, because clients do remember, as he alluded to, when you use phrases that people latch onto, they will remember. So I'm taking more risk, where's my higher return? Overall, really good recommendations. I like that you guys had some creative strategies that you recommended for clients, things that they might not have, you know, certainly not have thought of on their own with the Roth conversion, and so good job there. Very good professionalism. I like your presentation style overall.
And we will start up at 12:30. Please be in here by 12:25, as we don't like people coming in. People who are from competing teams, please keep the observations to yourself, and don't go back and report to other schools. And have a good lunch, and we'll see you this afternoon. Get settled in a bit. The gentlemen are set to go, but we'll wait and give a few people a few more times. We're scheduled to go at 10:35, so we have a few minutes to go. No, VCU, excuse me. VCU is here. And VCU, we have on the team, Virginia VCU. Okay, Crystal White, I guess I can guess who that one was. Adam Hancock and Gabriel Martinez. Did you say Gabriel or Gabriel? Gabriel. Sí. So that is our team. Our judges, by the way, we have judges from each one of the partners. Ameriprise, CFP Board, and FPA. Valerie Porter is from FPA. David Bresler is from Ameriprise, and Dr. Gillen is from University of Florida, representing CFP Board. So, just a few words. The students will have 20 minutes once we get started. They will be given cards going 5 minutes, 2 minutes. And if they do go over, we'll stop the presentation. It's the same rules for everybody else. We ask if there's anybody in the room who is affiliated with a competing team, please keep your comments as far as what's happening inside here to yourself. We don't want to give any kind of undue advantages to any team that's still yet to come. We have 4 this afternoon. We're all set to go? Good.
Is she timing it now? Okay. Hi. I would like to say thank you for showing to our home office. If you have any questions pertaining from our last meeting, can you say them now? No? Okay, then let's begin. Today's agenda, we are trying to reach 3 topics. The first one, which I'll be covering, is debt elimination.
And I'll be talking about your investment planning strategy and asset allocation.
And I'll be discussing your retirement plan and its details.
So, before I get on the debt elimination, I would like to tell you your current financial situation. Right now, your current net worth, which is your assets minus your liabilities, is around $425,000. And your spending money for each month is around $4,000. I calculated your spending money based on the information that you've given us, which is your monthly income minus your monthly expenses. Now, at our last meeting, you made it perfectly clear to me that you want to become debt-free. So to do this, I came up with 2 options. Option 1 allows you to become debt-free within a year. As you can tell, your payments increase significantly, so your monthly payment is around $4,800 a month to eliminate the debt. In year 1, your disposable income drops to $2,000, but in year 2, as you can tell, is an increase to $4,800. The main reason for this increase in year 2 is due to the fact that you are no longer paying off any more credit card debt or car loan debt. So this means you can go on a vacation or anything else you would like to do in year 2. I would also like to point out that Jeffrey's bonuses is not included in year 2's information. Now, if you feel that $2,000 for the first year every month is not enough, well then maybe option 2 is a better choice. Option 2, you become debt-free within 2 years. As you can tell, I left your monthly expenses, your monthly payments for American Express, as well as your car loan payments the same, which means you're paying around $2,800 per month for get rid of the debt. And disposable income in year 1 goes to $3,000, and your spending money in year 2 is $2,000. The main reason for the decrease is the fact you're still paying off that debt. Another reason, again, is Jeffrey's bonuses are not included. The reason why I did not include his bonuses is due to the fact of the uncertainty of the amounts. So they are being considered, but because they're not certain amounts, we just didn't include them. Now, this is a side-by-side comparison. I would like you to know, to reach this goal, you're going to have to significantly lower your debt by not using your credit cards. Try to avoid it unless it's an emergency. I would also like to point out that you are saving $800 in year 1 because you're not paying off the interest anymore. In option 1, because you're not paying off the interest anymore. Now, I'm not showing you your annual cash flows. What I really want you to focus on is 2016 and 2017. The reason for the decrease is due to the fact that this is when we project you start putting money aside for your retirement. Now, as again, you can see in 2018 that there's an increase, and that is due to the $50,000 gift that you received from Mark's parents. These cash flows actually do have tax implications in them, so you might want to go see a CPA as the year goes on. But we will keep track of your budget as well as your cash flows every so often just to make sure we're up to date with everything. Now, Mark, you called me this weekend and told me that you wanted me to come up with some ideas for your gifts and bonus income. Of course, I came up with a few options, but option 1 is retirement contributions. As a financial planner, I really want you to be able to reach retirement without having too many issues. I suggest you put an annual 8% amount in every year, but when you get the gifts and bonuses, I suggest you try to maximize your contributions. Option 2 is an additional real estate. You said you were thinking about a new home, just didn't know where. Well, set the money aside until you can find an area that you want to live in. Option 2 is adoption or surrogacy. You weren't sure if you were thinking about doing it or not, but I still crunched the numbers for you, and we go over that more in our next meeting. But again, stick the money aside so when the time goes on and you're ready for it, you have the money. Option 4 is home improvements. You're thinking about renovating your bathroom and your kitchen. Well, then here's the account that you do it from. Also, while you improve your home, you increase your value of your home. While you increase your value of your home, you also increase the net worth that you would have in total. So now I'm going to hand over to Adam.
All right, thank you, Crystal. Do you guys have any questions for her before I get started? Okay, then, let's talk about your investment planning strategy. Now, here at MHW and Associates, it's our belief that people tend to make investing more complicated than it really has to be. So we've designed a simple 4-step approach that we believe is going to be more than suitable for you guys to reach your financial objectives and reach retirement successfully. The first step in this process is to establish a cash reserve. This account is really going to serve as your safety net going forward. The second step in this process is to define your risk tolerance and build a portfolio that matches that risk tolerance. The third step in this process is to use different categories of investments so we can diversify your portfolio over a broad range of spectrums so we can manage the risk inside your portfolio as we move forward. And finally, we're going to be using the existing retirement accounts and assets which you've already acquired and compile those into a comprehensive portfolio that we can easily manage as we go forward in the financial planning process. All right, so let's begin with your cash reserve. Now, the reason this step is so important is it really serves as the foundation of your investment strategy. This is going to be your security blanket. Mark, you own your own business. Now, suppose one day you lose that business. Jeffrey, you work for a relatively new company. Suppose they're not doing well a few years from now and you get laid off. This is going to be the account that you can cover your monthly expenses going forward, to make sure you guys can generate some revenue in order to cover your monthly expenses. Now, the last thing we want you to have to do is tap into your retirement accounts in case of an emergency. It's also important to consider that this is going to be the account that gives you guys the flexibility to really do some of the things you guys have talked about in prior meetings. I know y'all want to go on vacations. I know you want to save up for a down payment on a new home. This is going to be the account that we can start planning for some of those things. All right, so now the question is, how much do we put in our savings account? Well, we recommend as a general rule that you cover or think about covering at least 6 months of living expenses. Right now, we are estimating your current monthly living expenses at $14,000. So this gives us a recommended starting point of $84,000. Now, I know this seems like a lot, but it's important to remember that when you open a savings account, you can start contributing a small portion of your paychecks as you go forward and develop the value in this account over a period of time. It's also important to point out that we recommend using a savings account because a savings account is going to be a safe place to put your money and a place that you can access your money in case there's an emergency and you need to get that money quickly. All right, so now let's talk about risk and where you guys are in terms of how much risk you're willing to take on in your portfolio. Now, when I refer to risk, what I'm really talking about are how much do we put in stocks versus how much do we put in bonds. As we increase your stock exposure, we increase your portfolio's exposure to market volatility. However, we also increase your growth potential. So when financial markets are doing well, you might see a large growth in a certain year. However, if financial markets are doing poorly, more exposure into stock assets, you might see a more dramatic decrease in your investment net worth. So the opposite holds true with bonds. As we increase your bond exposure in your portfolio, we limit your growth potential. However, we isolate your portfolio from severe market fluctuations. So now the question is, where do you guys fall on the risk spectrum? Well, based on the data that you've given us in our prior conversations, we're looking at around right around this area. So where does that put us in terms of how it relates to your portfolio? Well, based on our conversations and the data you've given us, we're recommending a portfolio allocation of 65% stocks to 35% bonds. We call this a moderate growth portfolio. And it's important to remember that this is a long-term strategy. And over the long run, you can expect a growth rate of around 7.5% to 8% return on your money. It's also important to remember, I know you guys are in your mid-40s right now. You've got 23 years to retirement. So why not increase your stock exposure? Well, the reason is, guys, we have crunched the numbers. And this is all the risk you need to take on inside your portfolio in order to reach your goals. And we are confident that we can get you successfully to retirement, and you guys can do some of your financial objectives that we've talked about along the way without having to take on any more risk than is absolutely necessary. All right, so now how do we manage the risk in your portfolio? Up on the screen here, I'm listing different categories of investments. And what's important to notice here is that each one of these categories of investments has different characteristics associated with how much risk and their growth potential. Now, one of the benefits you're going to get by working with us at MHW and Associates is that we have the ability to move around in between these different categories. We like to call them asset classes. And we can do this at very minimal cost to you. Now, this is going to be especially important as you guys begin to approach retirement, because as you approach retirement, we're going to want to decrease your risk exposure from that 65 benchmark to around a 50-50 allocation. Now, what this is going to do is it's going to reduce your risk in retirement, as well as generate a portfolio designed for income, which that's what your portfolio is there for while you're in retirement. All right, so do you guys have any questions up to this point? All right, now I'd like to talk with you guys about how we're going to implement this plan. Mark, I'll begin with you. So before I start talking about your existing retirement accounts and our strategy going forward, I'd like to talk with you about your business. Right now, you're set up as a sole proprietorship. Under a sole proprietorship, you really expose yourself to civil litigation. If someone were to sue your business and they won the civil case, they could seize your house, they could take your car, they could take the money inside your retirement accounts. And this is something we're really looking to avoid. So we recommend that you schedule an appointment with your business attorney as soon as possible and go ahead and reclassify your business as a limited liability company. Under a limited liability company, you will legally separate your personal assets from your business assets. So with that being said, let's talk about some of these retirement accounts that you already have. All right, so right now you've got your SEP IRA, your incentive plan, and your old 401k. Well, since you're a small, independent business owner, we are recommending you take these accounts and roll them over into a solo 401k here at MHW and Associates. Once we've accomplished this, we can begin actively managing that account with the strategy I outlined in the previous slides. Now, one of the benefits that a small independent business owner gets by using a solo 401k is the amount you can contribute on an annual basis into this plan. So with this plan, you're allowed to contribute $17,500 of pre-tax income towards your retirement. In addition to that, you can also contribute 20% of your self-employment income. So this is going to do two things for you. One, it's going to really increase the amount of cash that we can put towards your retirement and the amount we can invest for you. And two, it's going to reduce your tax liability at the end of the year. So how does all that sound? All right, now let's talk about you, Jeffrey. So the first thing we need you to confirm is whether or not your employer is going to be offering that Safe Harbor 401k. Now, if they do offer the Safe Harbor 401k, we also need you to confirm whether or not your employer will be making matching contributions and whether or not they're going to allow rollovers. Now, if they are offering the 401k plan, we'd like to review those documents ourselves so we can verify that the 401k plan isn't too expensive and has the appropriate investments in that plan that are relevant and prudent for your investment strategy. All right, so if they do offer the plan, and we believe that it's an appropriate strategy going forward, we recommend you take your old 401k and your simple IRA and convert those over to your Safe Harbor 401k. Now, this is going to be especially important if your employer decides to make contributions themselves, because that's going to be like throwing free money into your retirement account. So that's one option. Our second option will take place in the event that your employer does not offer the safe harbor 401k, or we happen to believe that the 401k is too expensive and the investment options aren't appropriate for you at this time. In that case, we recommend taking your old 401k and your simple IRA and moving that into an IRA here with us at MHW and Associates. In addition to this IRA, we're also recommending an additional tax savings account here at MHW that we can make some investment moves and begin saving money into. Now, the reason for this is simple. The contribution limits on a pre-tax basis inside an IRA are limited. So we need somewhere else that we can invest your money and put money away towards your retirement. And that's exactly what this after-tax savings account is going to be able to do for us. So there's my investment strategy. And unless you guys have any questions, I'm going to hand it over to Gabe, and he's going to talk about your retirement planning.
Thank you, Adam. Mark, Jeffrey, how you guys doing? Great. Well, at last meeting, you guys mentioned a couple goals. Number one was, Mark, you said you'd like to retire at the age of 65. And Jeffrey, you said at 68. That's great. We can do that for you. The second goal was you would like to retire with 80% of your pre-retirement income. Now, we've calculated the numbers based on all the assets and your goals and savings accounts that you've given us, and that number is going to look about $220,000 estimated in the year 2036 when you guys are going to begin your retirement. This is great, guys, because this money is going to allow you to continue your lifestyle and live as happily as you have been in your working days when you're retired. Now, the second goal kind of goes without being, it doesn't really need to be said, but we don't want you guys to run out of money because that's our responsibility. Now, how are we going to do that? Guys, in the year 2016, as Crystal mentioned earlier, we're going to need you guys to get rid of your debt by that year, your car loan and your credit card debt. And then we're going to need you guys to start contributing to your retirement account. Because let's face it, your retirement account is not going to fill itself up. So that year we've estimated, based on the numbers, that you guys are going to need to contribute $26,000. Now that's a lump sum. Split it up, it's about 8% of your yearly salaries. Mark, it's going to be about $11,000 for you. And for you, Jeffrey, about $15,000. And now listen, guys, I cannot stress enough how important it is for you guys to stay disciplined with your contributions because that's going to help us help you. We need your contributions in order for us to implement our investment strategy to get to your goals and to make sure that you continue to live that lifestyle that you desire during your retirement. Now, in the year 2036, we have estimated your account value, if you follow our guidelines, at approximately $3.3 million. This is the money that you're going to need in order to have that lifestyle and continue it as you're retired. $3.3 million is the amount that you're going to need in order to continue it and live the life that you want. You don't want to buy less. You don't want to you want to continue doing the things that you like to do. Your first withdrawal that year, as I mentioned before, is going to be $220,000. Now, it's going to be great to celebrate your first year retirement. But every year after that, we're going to need to monitor and readjust anything that we deem necessary in order to continue your withdrawal rate throughout your retirement. In the year 2057, Mark, you're going to be 86, and Jeff, you're going to be 89. Roughly, you're going to have an estimated account value of $1.1 million. Once you withdraw for that year, it's going to be around $453,000. You're going to have $757,000 left as a cushion. Now, this is the best part, guys. We did not include Mark's $1 million inheritance at the beginning of your retirement or your Social Security benefits. Not because we didn't think they were important, but because we wanted to build you guys a worst-case scenario plan. We accomplished your desired goals with using the least amount of financial resources. And that, to us, is a win. Because anything else, we look at it as frosting on the cake. This is great. You guys are going to, we feel confident that with that cushion and the inheritance and your Social Security benefits, you guys are going to have more than enough to continue the lifestyle that you desire and live and have your money last you as long as you live. Because at the end of the day, those are our two goals. Now, Adam's going to touch briefly on a few steps that we're going to do from now into the next meeting.
All right, thanks a lot, Gabe. All right, so there's a few things we have. By the way, we have your next appointment scheduled 2 weeks from now, which we agreed on yesterday. And there's a few things we'd like to see you guys take care of between now and then. The first point We'd like you guys to go home tonight, talk amongst yourselves, and select one of the debt reduction strategies that Crystal outlined previously. There's the 1-year strategy and the 2-year debt elimination strategy. Second is Mark. We'd like to see you meet with your business attorney and reclassify your business as a limited liability company. Once we've done that, we can begin consolidating your retirement accounts. But Jeffrey, we need the paperwork on the 401k plan at your new employer so we can review that and see if that's going to be the optimal strategy for you going forward. And finally, we'd like to see you guys open a savings account and begin contributing.
Unfortunately, I have to cut you off.
That's fine.
They are really 20 minutes, and it's all that particular time. Thank you very much. I know you're getting the last point across, but I had to call you. So we'll give the judges a little bit. You guys can break down.
We were at our last slide anyway. So
Yeah, I
was
know.
just trying to rush through that.
Hi, guys. Great job. So what I want to do is give you some general feedback for the group as a whole, then we'll talk kind of individually about each of the sections that you worked on. So the first thing that you did just a fantastic job is you offered options. So that was really helpful to us as the clients. It wasn't this is the only way to do things. There's actually a few things to consider, pick an option. That way of approaching things is just incredibly helpful. The other piece that I really appreciated, especially at the end, was there were some pretty clear action steps for us as clients. It wasn't too complicated, and you didn't leave us with too many to-dos that we made it impossible to overcome. You did a great job just sort of summarizing, here's the quick things. A few general opportunities for you. The first is to use more numbers. So you talked about accounts by title, but not necessarily by number. So I might not remember exactly which is my SEP or my solo or my IRA. If you said, that account you have, SEP IRA has 110,000, that sort of identification is really helpful for clients that maybe aren't familiar with our vernacular as much. The other piece is all of you had a ton of enthusiasm. You did use a word, though, that I just caution you against, and that's guys. Now, this is a weird situation because obviously both the clients are actually guys, but trying to use a word like folks instead of guys sort of just it shows, it's a term that I certainly used in the business when I started when I was a little bit younger. Trying to use a less sort of young person's word can be really helpful and show a little bit more professionalism. That being said, I think you all look great. So let's talk about the individual sections. So Crystal, you did, like I said, you did a great job with some of the options, working through not only the options for debt elimination, but also talking through options for the gift and bonus. And that scenario you laid out is a perfect example of what really happens. The client calls up and says, hey, what do I do with this? What do you think? You did a great job there. In the beginning, you had an opportunity to react a little bit to the net worth and expenses. And step one is stating what it looks like. Step two is saying, well, if this is good or bad, or here's how we feel about your net worth and why that's important. Adam, you covered a lot. So in the framework you laid out was really, really helpful. So by laying out, here's how we think about investment planning, that's the sort of thing that's actually going to stick with me as a client. I'm going to remember those 4 steps, and you were really helpful in kind of going, this is step 1, step 2, step 3. That sort of process of presenting is really useful. I love the way you talked about cash reserve. So you didn't just talk about cash reserve as an abstract thing. You actually mentioned, here's some scenarios. If your business doesn't do well, you used some real world scenarios to help me sort of understand why this is a big deal. You did a great job of talking about recommendations for asset classes and risk tolerance. The big piece I'd encourage you to think about is doing a side-by-side. So here's where you are today, and here's what we're recommending, so I can kind of see a little bit of a comparison there. Last, Gabe, you have massive enthusiasm, which I definitely appreciate. Here's the, you do use guys a lot, but here's where I really appreciated what you did. Your enthusiasm and energy it is a great thing to have with clients. So I, as a client, sat here and thought, he cares about my situation, he cares about what we're doing, and he has the confidence to lay out some pretty, some strategies. And you use, I think you had don't run out of money as a strategy. It's kind of hokey, but at the same time, it makes sense, right? The last piece, which I think you did a great job on, is pointing out that you built the plan that doesn't involve Social Security, doesn't involve the inheritance. That's the extra stuff, the frosting on the top of the cake. The way you articulated that, I just thought was really great.
I think you all did a great job overall. Just a few key points. Crystal, I like that you recommended the CPA. Always recommending other professionals is great, and I like that you presented several options within everything. One thing I would like to see, when you look at the debt elimination, maybe putting it side by side to what I'm currently doing. And so you can see the key differences between options 1 and 2, and then maybe help me think through where I might be able to get, eliminating or cutting back on some current expenses maybe to be able to use some of that as well, to look at eliminating some of the debt. Adam, you did a great job bringing it back together and asking, do you have any questions? Are you following us? All of that kind of stuff. Diversification was really good, and lots of really good explanations and logic behind what you were advising. You really said, okay, we think you should do this, but this is why we should do this, and kind of how it would go within that. I really like the implementation plan. I like that you discussed the liability with the business and recommended the business attorney. I think that was a great step. The one thing I would ask is the savings account for the emergency fund. That was a substantial amount of money to put into just a savings account. So maybe looking at other alternatives with dividing that up just a little bit. Gabe, I thought you did a great job. You restated the prior goals, kind of summarized where we were at before, and then kind of brought it back together with where we were going. And then I think, the action plan at the end, I know we didn't get through all of it, but I think you've done a great job of bringing it all back together and given really key, simple steps that I need to take to follow to get ready for the next meeting in 2 weeks.
I echo everything that has been said here. And I also wanted to say from a business standpoint, you guys did a really good job with some assumptive selling. We want you to roll this account over here to us, and that's okay. I mean, you also want to have a continued relationship with that client and have their money to manage. So I thought it was really good. It was assumptive, but it wasn't like you will open a brokerage account. It was just, and you used some good language. Consider doing this. Here are some options for you to think about. That's good to give clients choices. But you also disclosed biases in those recommendations. So as your financial advisor, I want you to save this much money, or I want you to have this much money, but clients recognize that when you're wanting them to do that, even though it might be painful to save $84,000, they know that you're doing it with your financial advisor hat on, but it's also helping them to get to their goals. So I like that you had that assumptive selling, disclosing those biases in there. And then definitely really good recommendations. I thought your visual presentation was really supportive of your plan as well. So good job.
Learning street that goes on in this situation.
Thank you. I wanted to talk to you. I said, I love their shoes you had on.
I couldn't wear them today.
Well, I know. What were they?
University of Incarnate Word do you say Felipe or Philippe? Philippe, what's that? Villarreal. I was going to say we're doing it that way. Okay, good. Crystal Gonzalez. And I have Marisa. Oh, Crystal's not here. Marisa Vasquez. Okay. Very Latin. This is Maria Vasquez Arroyo Vasquez. I know.
Yes.
We'll get started in just a moment.
All right. Great.
Ready?
It's
So you know what to expect. When you are finished, you'll break down. While you're breaking down, the judges will confer, they'll get their notes together, and then we'll have about 7 minutes or so that they'll give you some comments.
Welcome, Mr. Stanstrom and Cragmore. I hope you remember my partner, Felipe Villarreal, and myself, Marisa Vasquez. Really nice to see you today. How are the dogs doing? Wonderful to hear. Please have a seat. As you know, our vision and our mission is to create a financial plan to improve your future. Now, while we're presenting, please don't hesitate to stop us at any given point to ask, where is this number coming from? Or what do you mean by this? Because this is your plan. We're here to help you. And if you don't understand our work, we're not going to be able to improve your future.
So a good overview of your current financial situation is to use financial ratios. Basically, ratios are just a good point. We can create your numbers, put in a simple equation, and see how we're doing against benchmarks. The first one that we selected 4 ratios. There's many out there. We selected 4 that cover a wide range of topics. The first one is the debt ratio. This one's a pretty simple equation. Basically, we just take your liabilities, any debt that you might have, a mortgage, your credit card bills, a car loan, and we divide it over your total assets, what you currently have. The benchmark is in blue. Benchmark is at 40%. We are currently at about 54%, so this is a little high. However, I believe that you would know this because one of your priorities was to reduce debt. So you do know that that is a topic that you need to work on, so we'll definitely show you how to achieve that goal and bring that debt down. The next one is an emergency fund, a rainy day fund. Things happen. You might lose a job, you might become disabled, God forbid, of course, for both of them. But you do need some funds to get you through those tough times. Currently, at the minimum, it should be 3 months or 25% of your annual income. Currently, we don't have enough. We have only 5%, which might get you through maybe half a month, if that, in liquid savings. So we will definitely show you how to increase that as well. Savings-wise, you should save at least a minimum of 10%. You don't have a distinct plan of, okay, I'm saving X amount per month currently. So we would recommend, and we will show you later on in the presentation in this meeting, what that is to increase that to at least minimum 10%. And finally, our housing ratio. Basically, all your housing payments divided by annual income. So we want this to be low because we want the payments to be as low as possible. You're currently doing a good job. You have your rent and also a mortgage on your second home, your weekend home. The benchmark is at 28%. You're currently real under that, 22%, which is very good. It's very good for you.
In this meeting, we're going to focus on 3 topics, which is becoming debt-free. We planned out for you to become debt-free in 16 months, and we're going to explain that thoroughly. We're also going to improve your budget, and that's by reducing a little bit of your budget expenses, monthly expenses, to be able to contribute for your retirement. And we are also going to focus in your retirement plan. At the end, we're going to go a little bit over other goals like estate planning, but mainly we're going to focus on the 3 top ones. So paying off your debt. You gave us 4 major points you wanted to clear, and that's your car loan. You're currently making monthly payments. We want you to continue doing so, and Mr. Jeffrey, when you get your bonus, we want you to completely eliminate the car loan using your bonus. Now, for your 3 credit cards, you told us you had $3,000 left over of your income. $2,500 are going to go towards your emergency fund for rainy days. Now, the other 500 are going to be used for your credit cards. 400 are first going to be used in your Visa, and 100 in the MasterCard. This is how it's going to look like. See, the payments are going to be $400 monthly. And we first decided to pay up your Visa since it has the highest interest rate of almost 18%. Now, in month 9, you're going to be able to pay it off completely. We're also going to use part of the bonus that Mr. Jeffrey is going to obtain in month 8 to be able to pay it off completely in month 9.
The next one is the American Express that we should pay off. You're currently paying off $2,000, which we calculated in the put in your budget. So we recommend that you pay that off until month 9. That's when you pay off the previous credit card, and all those payments would then fall into this credit card, and then come month 15, you'll be pay it off completely. And then finally would be the MasterCard. This is the lowest interest rate, still pretty high at nearly 13%, 12.99. Currently owe $5,000 on it. We recommend, again, as Marissa said, out of 500 originally that you have left over, 100, keep making 100 payments. Week 9, month 9, that first credit card is paid. We'll switch to the American Express. Once the American Express is paid off on month 15, that's when all the funds will shift over to the MasterCard and pay that off. Come in 16 months. So just a year and a half, you'll be fully debt-free, other than your mortgage, which you said that was fine. You just wanted to pay down the credit card and the car loan.
Now, do you have any questions regarding your paying off the debt? No? Great, that's wonderful. We'll keep on going. Now your budget. This is where you currently stand. As you can see, a large portion goes to the New York home, and that's because you're paying $2,000 to the American Express debt monthly, and you're also paying for an apartment in New York City of $3,500. You also have large amount in your upstate house on your business service, and well, this is overall look. And this is where we want you to be in our proposed budget. The thing I want you to focus on this slide are the percents. As you can see, don't change a lot. And that's because we don't want you to change your lifestyle much. So we reduced a little bit of each portion. Now, here's where I want your feedback. You know, maybe you feel more comfortable reducing your dining out and, you know, keep on pampering your pets the way you're doing so. Or, you know what, or your pets are your adoration and you want to keep on doing it the same way, but you want to dine out too, it's okay. We can reduce your cable connection or your internet. I mean, we're going to work this around so it fits your needs, because we want you to be satisfied. We want you to be comfortable. So this is all up to you. We want you to consider it, and we want to be able to come up with a real plan that you will be able to follow. I do want to focus on the New York home since it's a large portion. On our last meeting, you said you were considering renting a cheaper apartment. You weren't crazy about the idea, but you were considering it. We do want you to take that step forward. We talked with a few real estate agents. We told them we didn't know exactly where your apartment was located in New York City, but for a budget of upper $2,000, maximum $3,000, they would be able to find an appropriate apartment that would suit, you know, that would be like the one you're currently living in. So your lifestyle wouldn't change much, but we would be saving $500 more. So the payment would go down from $6,040 to $5,540. Now, in 16 months, when you're debt-free, this number is going to even reduce more. And that's because you're not going to be paying for the $2,000 for the American Express. So your percentage are going to change overall, since that fraction is going to diminish. And what I want to make sure that you understand is we're not going to change the business services. Even though the percent changed, the payments that are going towards it are still going to be the same, because we don't want you to grow your business. We want you to spend more time in it, and we're not going to cut down on those expenses at all. Any questions before we keep on going? Okay, I'm glad you don't. but still we want to hear your feedback in our next meeting or when we're done.
One of the major things in any financial plan is retirement. Because most of the once you do retire, you're going to spend the rest of your life in retirement, and you want to live comfortably the way you choose. So there are certain assumptions that we have to make to calculate retirement and how much it would be. First is inflation. We usually use 3%. Generally, on average, historical average, inflation is about at 3%. The rate of return for investments we put as 8%. That's around the 30-year average return. Again, some years there will be a lot better, 15%. Some years there might be a loss or a small gain of 1%. But on average, 8% is a good number to work with. Jeff and Mark, you stated that your life expectancy, Jeff, you said 86 years. That's what you expect to do due to your other family and family members. And Mark, you stated 89. Both of you wanted to retire at the same time. That would be in 23 years from today. And then both of you said you would live 21 years actually in retirement together. So those are all the assumptions that we have to make to come up with a number, a figure for you to just find out how much you have to save per month or per year. So we go with our projection. So we project that you need $152,668 per year in today's dollars for retirement. Now you might ask yourself, how did we calculate this number? We did our proposed budget. So that's that number, and we subtract mortgage payments because you would have that paid off by the time you retire. And we also took away, Mark, your work payments because you'll obviously be retired. And we get to that $152,668 number. Due to inflation, that 3% number that we talked about earlier, in 23 years, you would need $301,303 per year for each year for 23 years in retirement. This will be a total, so you would need at the start of retirement $4,103,013 at the start of retirement. Now this might sound like a big number right now, however you guys have done a great job at saving for retirement previously. You guys have many plans from former employers that you guys have started saving, and you guys did an excellent job. Accounting for what you've already done and what you already put in, and it growing at our 8% rate, we would projections show that you should save $2,574.83 per month, addition to what you guys are currently doing.
And this may look like an alarming large number, but remember, already with the budget cut you're saving approximately $1,800. And Mark, if you do spend more time in your business, let's say you grow your payment for 20%, then you would have a monthly income increase of $2,000. So you're over this number. This is obtainable, and we do want you to consider it.
Do both of you gentlemen have any questions about retirement or anything else? No? All right, excellent. Now, you might be wondering what type of retirement plans you should put this into. Both of you should have a traditional IRA. Maximum contribution in 2013 was $5,500. Jeff, you also talked about your company possibly getting an employer plan. We possibly believed it was a safe harbor 401k. We haven't received feedback on what it was exactly, but if it is a safe harbor, there would be at least a mandatory employer contribution of 3%. So they would match up to 3%, and employee contribution of up to $17,000. And then so if you recall the ratios at the beginning, this is the red, that's what you currently have, our benchmark. And if you take in our suggestions, that would be the green proposed line. So for debt ratio, after just having a mortgage, after you pay off the debt, it would be right below the 40% mark at 39%. Rainy day fund, we suggested that you stop at 3 months, but you can obviously say more if you feel like it. So that's 25% of the annual income. saving that $2,500 and change for retirement, that'll just put you over 10% at actually 11%. And then by lowering the rent by $500,
Yes.
you will lower the front end, the mortgage payment to 19%.
So to wrap things up, we showed you how to become debt-free in 16 months. We scaled down your budget, and we want you to save $2,940 a month for retirement. Obviously, this can all change. We want to accommodate your needs. So we want feedback from you from each of the points and the following that we'll discuss later to be able to create the plan that will really fulfill your necessities. If you feel like 16 months, it's too little, you want to go further, we can change that. So please be free to tell us exactly what you're feeling, what you want, to be able to shape this in what you need.
Other topics that we didn't include here in our meeting today, but is in your packet that we gave you, is estate planning. Before we actually did the financial plan, we presented it to you in paper form. That was before the Supreme Court decision that you guys are allowed to actually legally married and be recognized as a legal couple. So that will change from our paperwork that we gave you. However, we do have estate lawyers that we know and would more than be happy to explain that, what the ramifications are for that. Asset allocation for your portfolios. You guys do have several retirement plans. We went into a specific detail on how we suggested that you move your assets to generate that 8% return that we are projecting. And then you also talked about wanting adoption or surrogacy options. In the material that we gave you, there are several numbers that you can call to receive more information. We got some costs. And then obviously, if you do decide to adopt a child, obviously the numbers would change. That's a whole different budget. Creating a family, that's a whole other budget. So we will be more than glad to rerun the numbers for you and create a new plan for you, because a plan is always changing.
So as we said, this plan is going to change to accommodate your needs, and it's going to keep on changing. If inflation goes up, we're going to rechange this so it's on track. And we would like to meet with you in 2 weeks in the same room, in VJV Consulting Room 2, at the same time, 1:15, November the 1st, if you can. If not, just email us or give us a call. If you want to ask us any questions before the meeting, you're also very welcome to contact us beforehand. And we look really forward to meeting with you again, since we have a lot of topics to go through, and we want your feedback about these 3 topics we discussed today.
Was there any questions before we take off for the day? No? All right, well, it was nice meeting you. We'll see you in a couple of weeks, okay? Bye.
So we'll give our judges a little bit of time to confer. I was a judge last year. We were talking.
So we'll start with just some sort of general feedback and then walk through the presentation. So, I love the way you started with your consulting group's vision and mission. I just think it's a really interesting way to start to sort of center the client on what it is that you believe in and how you want to work with clients. So that was really interesting. I appreciate the use of ratios. Ratios is potentially a scary word to clients who maybe it may not be comfortable with that. So I might think about using different words, but the idea of using that as as your template both in the beginning and the end was really nice. So to see both where you were, where the benchmark is, and then where you ended up after the recommendations, I thought was a really nice touch. The one piece I would think about doing is talking about why some of the recommended ratios are what they are. So why is it 40%? You know, where did that come from? Is that your recommendation? Is that a standard recommendation across the industry? Like, what does that really mean for the client? The order you went through the goals, I think, is spot on. So you chose to talk about getting debt-free and the budget first before moving to the other things, which for a client like this is just really important. I might just make a bigger point about that. You're going through this very specifically in an order because this is, you know, you can't really think about retirement until you get all these credit card debt paid off. I thought you had a great strategy to pay off the debt, and the way you went through it was, I think, spot on. The one piece I'd have just from a presentation standpoint is maybe just one slide that sort of laid out, you know, exactly what are we doing. So you went step by step, but one last sort of wrap up for me might have been really helpful. Budget, I think you did a great job laying out that, and here's where you really started to use the word feedback. Marissa used the word feedback a lot, which I think is great. So you continually checked in with the client to say, look, this is our thoughts, but we want to hear from you, and this is not a steadfast, has to be this way. That was a really great way to approach it. With retirement, there was one word that I wrote down, and I can't remember which of you said it. Marissa, you might have said it, that after laying out some of the amounts and potentially some big numbers there, you sort of said with enthusiasm, but the good news is this is obtainable. So, you know, just pausing to have sort of a human approach to things can be really helpful when you're laying out some huge numbers for clients. Last thing I'll just add, I think the way you ended it was great, is recognizing that there's some other issues you didn't have a chance to cover, but you're going to cover them next time, and making sure that they did not leave without a set appointment. So there's no way this will linger and be months and months till you get something done. There's an appointment on the books to meet with them in 2 weeks, which was great.
I think you all did a great job as well. I really liked the details that you provided for paying off the debt. I liked the charts. To me, it was very visual. It helped me look and say, okay, this much is going toward my interest and this much is going toward the payment, and then I could see how you layered it to show how much more would go toward the next payment once it had been paid off and everything. On the pie charts where you showed the percentages, to me, it might have been helpful because you did make the point that, well, we're not changing this even though the percentage changes, maybe to show the dollar amounts, and maybe not necessarily on the pie chart because that would get really busy, but that would show me that it's constant, and then you could have percentages, you know, columns for that on out from it if you wanted to, in kind of a change column as well. So that might have been, you know, helpful to keep that on track a little bit. I like that you had the assumptions kind of showing with what you were going with, and then, you know, asked if they had any feedback. I like that you brought endowment, all of that into it, and also that you recognize that if they do adopt or have a child, that will kind of change the whole game plan, and they'll have to come back and think about that. And probably the one piece I'd like to have a little more about was, okay, so we're going to meet in 2 weeks. What do I need to do in those 2 weeks to be prepared for that? Is there any homework I need to be doing, or anything I can think about, or any changes I need to address right now? So that might have been a little helpful. And I didn't hear a lot about referring me to anybody else as far as any other relevant professionals. I didn't hear a whole lot about that, but okay.
I actually did. I noted that they referred them to a real estate, well, actually they had conferred with a real estate agent, and then they did refer to the attorney for estate planning, those changes related to the effects of DOMA. They've captured everything that I wanted to say, including with the pie chart especially. I would have liked to see numbers with that. The percentages, it's hard to think in percentages. I need to know, you know, actual dollar amounts. And I liked the illustration of the debt elimination strategy. I would have liked to know why. You said we were paying off the highest interest rate credit card first, and I know why, but does the client know why? That you've gone back to that. I thought you did a great job checking in for questions and feedback, and I love that you recognize the emotional, like, whoa, this is a big number, don't panic, this is doable. So just to reiterate what David said, but very good job. Thank you very much. And good visual support too of your presentation.
Are they outside?
to start off at 150. We are miraculously ahead. Is UVU, Utah Valley University. The participants from there are Sam Deaver, Scott Carlson, and Adam, do you say Lalas or Layas? Lalas. From, as I said before, from Utah Valley University. Our judges are from representing the three partners that bring on the event, that partner in the event, CFP Board, Ameriprise, and FPA. And representing Ameriprise is David Bressler. FPA is Valerie Porter, and Dr. Marty Gillen is representing CFP Board, and she is at the University of Florida, and not at the game since she's a Kentucky fan anyway. Ready to go, UVU.
Right there, just right here. Okay. Hello, how are you all doing today? We're so grateful that we're able to be here with you, and we've had a couple of meetings, and we're very excited to be able to be here and discuss those things that we've talked about in our previous meetings. Now, the purpose for us being here and the three main topics that we're going to be speaking about is cash flow, family planning, and retirement planning. And as far as cash flow goes, the goals and priorities that you had set and addressed that you feel strongly about is to become debt-free, also to create a stress-free budget, build an emergency fund for you and to provide for the just-in-cases, and to fund annual vacations. We're mainly going to be focusing on eliminating credit card debt, budgeting, and building that emergency fund. As we looked into your financial records and developed your personal cash flows, we looked and we noticed some strengths, weaknesses, opportunities, and threats that you may be faced with. Your strengths are things such as you have high salaries, you have a lot to play with as far as income. Also, having dual income is a very strong thing. It helps with taxes. It helps to open up a lot of opportunities with funding. We did notice that there is some overspending by about 20% of your income. And most of those things are through what are called variable expenses, or expenses like shopping or dining, things that you have the most control over in your budget. As we looked at opportunities and threats, we saw in opportunities, you have the opportunity to personalize your budget to fund the things that are most valuable to you, to your highest priorities and to your goals. We also have the opportunity of eliminating that credit card debt to create cash flow so that you can begin to fund those things as well. Some threats faced, there's quite a bit of interest on credit cards. And so that creates a constraint as far as money coming in and out, and it can lead to further debt and less financial freedom. Our recommendation is to create what is called a credit card snowball, or a credit card elimination plan. And we're from Utah. You can imagine, we don't get a lot of snow here in Florida, but in Utah we get a lot of snow. And you can imagine a snowball rolling down a hill. It starts with even a very small piece, and as it continues, it builds on itself, and it collects more and more mass, and it creates more and more energy as it flows down the hill. And so we'll be coming back to that as we kind of get into it here. And we also will be building that emergency fund, using money that's freed up through that elimination to build that, and then to start saving now, helping you to start funding your goals. There are also a few alternatives we've looked into. With your variable expenses, doing a cash-only system for dining and other things to actually set aside cash in envelopes to be able to take when you take taxis or take when you go out to eat, and paying cash only for those things. Also, extra paychecks. If you get more than 2 in a month, you can put that extra paycheck down towards your debts. This is an example of how the snowball, in theory, can work for you. We had set aside that certain amount so that you can keep paying the minimums on, or your standard payments on your other cards, while you take that extra, $12.50 here, and you lump it into paying off your Capital One Visa first until that's fully paid off. And then you take the savings along with that extra lump sum and put it towards your second card and your third and fourth until you're able to pay off your debts. We have a comparison here of not using a snowball versus using one. With no snowball and just paying your normal payment, you'll be able to get rid of your credit cards by 2021 and spending on interest, spending $7,500. If you use the snowball, this is why we recommend it so heavily, if you use the snowball, you're able to pay it off by the end of, you will have the opportunity to be able to pay it off next year, along with saving about $6,000 in interest. And emphasize here, 7 years is a lot of time, and $6,000 is a lot of money that we can help to free up for you. Now, as far as your stress-free budget, we want to help you to be able to minimize the amount that you have to worry about money and talk about money. And so we have this first column here is showing what your current budget is. This is how we're looking at cash moving in and out, and right now that you're spending about $20,000 a month. And we want to be able to help you to free up that cash flow. And so we've gone into looking into ways that we can minimize that extra spending, and ways that we can help you to and cut back. We can see we can save you about 39% or $8,000 in budgeting alone. So that'll help you to put most of that money towards the most important things for you. And with that savings, we'll be able to put it into an emergency fund. There are a lot of alternatives, but we're looking at 3 and 6 months emergency savings for expenses paid if something were to happen. 3 months, about $65,000, which will take 8 months to save for, or 6 months, you can continue, and it'll take about 1.5 years to save for. And then once we get those things squared away, we definitely want to look into helping you to take that dream vacation you've been looking for.
So the next part, one of the major goals you guys had was financial planning. We realized or family planning. We realized there are a lot of other goals out there, but with a lot of emphasis was on family planning, creating a family, adopting, looking into surrogacy, looking at different options. This is a financial decision that needs to be made, as well as a very personal decision between the two of you. So what we've done is we've gone through and we've looked at the different types of adoption and surrogacy, the different costs, the pros, the cons. And we wanted to summarize those and kind of go over those. The first form of adoption we wanted to look at was foster care adoption. This is very seldom thought of as a form of adoption. It is by far the cheapest due to government subsidies, and it's about $500 to perform a foster care adoption, due to the government will help pay for the child's education, the clothing, the food, the education expenses. It really helps you be able to afford that. Some of the cons are, is the long list to get a healthy baby. To receive a newborn infant on the foster care list who is in healthy and perfect condition and good condition, it's very long. There's a long waiting list. There are plenty of children in the foster care system, older teenagers, adolescents, young children. Most of them will have mental or physical struggles, developmental struggles, and so that can be a deterrent for some couples in their decision. The next option we looked at was domestic adoption, adopting here inside the United States. This will cost between $10,000 to $30,000 to perform this adoption. A lot of that will be the fees that you pay to lawyers and agencies. The wide range on this adoption is the travel costs. if you're able to adopt, and here in New York or on the East Coast, your travel expenses will be lower than if you're going to New York or going to California, Seattle, these different places. So that's variable. One advantage of the domestic adoption is that there's a $6,000 tax credit per child adopted this year. That can help in our tax analysis and our tax planning for future to come. Probably the largest advantage of a domestic adoption is the amount of medical records. The medical records that are performed, that are kept here in the United States, are vast. You're able to go and see the mother's medical records. You're able to look in and see if any harmful substances were taken while the child was in the womb in development. You can look into see if depression runs in the family or any other types of diseases you may be worried about. So the medical records are extensive, and you're able to go back and look at them. The next option was international adoption. This is a very popular option in today's society. It is more expensive, $10,000 to $50,000. Again, variable costs being travel costs. A lot of the costs are going to be the lawyer as well as the adoption agency fee. But one problem with international adoptions, one possibility we saw of problems with is the minimum amount of record keeping in other countries. If you're adopting from China or Africa, you might not know the medical record of that family where your child is coming from. You don't know if the mother has taken harmful substances while the child's being developed, which could cause later developmental issues. One thing we would recommend if you do choose an international adoption is to choose an agency that is inside the United States as well as the foreign country. This will help speed the process up, smooth the process along, and keep it very seamless. The last option we looked at was surrogacy. Surrogacy is the most expensive option. It is the most, it lets you choose the most customizable. Between $55,000 to $100,000 for a surrogacy birth. Due to the fact you are paying for the mother's livelihood, you're paying for her living expenses, her medical expenses, you're paying for everything. You're making sure that that mother is taken care of while she is holding your baby. It is recommended to set aside 10 to 20% extra of what we expect that to actually cost for unexpected expenses, medical issues, anything that comes up. It's nice to have that buffer. Great advantage is the limited health. You get to choose the mother, and there's a very limit. The limit on the health concerns is very slim. You can look at the medical history. It's very open and very easy to see. So here we have a graph of the high cost, the most that these will actually cost to perform. You guys are receiving $50,000 every 3 years from Mark's parents. We did not include that in the budget. We specifically set that aside to help pay for an adoption, to help pay for this, to help fund that. With that gift, we would like to look at that and see how that's being gifted and if there's a better way to gift. So together, what we really want to do is we want to be able to sit down, pick out a lawyer who is fluent in adoption law, and also research an agency together. We have a list compiled that we can go over at a later time. But what you guys need to do as clients is to educate yourself, make sure you guys are ready for this commitment, engage in the placement process of the adoption, become familiar with that, file all legal documents, we'll make sure we have a good lawyer and a good agency for you, and become parents. We recommend the domestic adoptions due to the fact of the increased medical records that we can find. Though we know this is a very personal choice, and we look forward to working through this process and finding the one that suits you the best.
So Mark and Jeff, you also mentioned to us in our initial meetings that retirement was something you really wanted to plan for. And we wanted to commend you for the savings you've already had so far for retirement, and also just commend you for this goal. A lot of people put this off until later, and at your age, it's very important that we definitely look towards retirement and see what your options are to do now to help improve your financial situation. So we wanted to quickly just go over what you mentioned, to have enough for retirement. We want to help you define that. And also just to go over the priority you had of having us look over your investments. And that kind of ties into our recommendation is with retirement planning. So we defined that goal as having a little over $4 million. If you take into Social Security, what we'll be getting from that, from the data we gathered from you, the extra money we're going to need to kind of help you create the income in retirement is a little over $4 million. So I want to talk to you a little bit about how we're going to help you get you there. So one thing we thought was important is that you were both part of this goal. You're both helping to save, and we have some specific dollar amounts here for you. Mark, you currently have a SEP IRA. You could actually contribute more than this amount. We just thought that it matched up pretty well with what Jeff could contribute. But you could contribute this much to your SEP IRA. And then for Jeff, we recommend having you contribute $5,500 of what you'd be contributing here into just a traditional IRA, and then the rest in kind of a brokerage account that you could access later. But Jeff, your company may be having a 401k plan pretty soon, and you could just easily be already used to saving this amount, and then if the company opened up that 401k plan, you could take advantage of that and have that for this year. So with actually saving that much, we projected you get around that goal of having about a little over $4 million there. And also to help you get you there, we wanted to kind of go over some recommendations for your investments. But we want to help you understand that it's not just a cut and dry of saving this amount and for retirement. There are alternatives. You could retire later if you wanted to. We could talk about that. Working part-time in retirement is something that a lot of people consider, especially nowadays, saying, I'm going to phase out of retirement possibly. And that could also help you in your decision. But also saying if you want to spend more now, we could help set your expectations of saying, okay, you spend more now, but you might want to look at spending less in retirement and see if that is a good option for you. So as far as your investments go, we want to take a look at some of the advantages. We definitely looked at the cost, and they're actually very low-cost investments. We really like that about what you currently have. Some of it is a little concentrated in one fund or in a particular type of investment. There's definitely some opportunity to diversify in your investments, but also we feel like if you don't take some certain precautions, you could not reach your goals based on your current investments you've selected. So we kind of looked at a really high level of kind of some big types of investments you have, so kind of 75% in bonds, 20% in stocks, 5% in cash right now. That's kind of where you're currently at. And we wanted to recommend maybe a higher allocation going to stocks. We kind of show a specific percentage here of stocks, bonds, and cash to help you achieve your goals. You took a risk tolerance questionnaire, and we feel based on that you could handle this type of risk, and it would help you achieve your goals of retiring that amount. So we wanted to break this out as far as what you need to do and what we need to do to help you get there. So Mark, we talked about contributing to that SEP IRA. To help simplify things, we can help you work with your other companies, 401k plan sponsors, other retirement plans, to get those all rolled over into to one account or a couple of accounts for each of you. And also, we want to take a look at those specific investments in each of those accounts and help you make specific recommendations once we've consolidated things. And also the next time when we meet, we want to go over tax planning, insurance, and estate planning. There's definitely a lot of issues we haven't covered today. We realize that. And there's more we want to go over next time. And that's going to be what we'll be looking into for our next meeting. So just a kind of high-level summary of what we talked about today. For the cash flow, helping you, we wanted to look at some different budget changes and also implementing the snowball system of paying down your debt. We recommended the domestic option. Again, we want to emphasize this is a very personal issue, and although we recommend it, we understand that this is a very sensitive topic and it's personal for you and it's your decision. And also retirement, just to sum up, save more for retirement and kind of changing some of those investments you have specifically right now. So thank you so much for your time. We really enjoyed it, and thank you so much for coming and meeting with us today.
Okay, as the gentlemen break down, the judges will confer and get their notes together. The notes are
Before we get started, I didn't get a chance to catch everyone's names. So who's who?
I'm Adam Wallace.
Adam. Great.
I'm Scott.
Scott.
I'm Sam.
Sam. Cool. All right, so let's we'll start with just some general thoughts, and then I have specific sort of thoughts about each of the sections, and my co-judges will certainly add some thoughts. So overall, I thought you guys did a great job. The presentation I thought was really slick. It looked great, really professional, and the way you went about sort of walking through section by section was great. A couple of sort of things you did that I really appreciated. First was the use of a SWOT analysis. I had actually never thought about using that with the client. I mean, we use that all the time in a kind of a business setting in the corporate office environment, never with a client, and that makes a ton of sense. So that was a great way to approach it. The other thing that you did was, for many of the recommendations, you also presented some alternatives, things to think about. My one sort of twist that I would ask you to think about there is you presented the alternatives, but then didn't ask what the clients thought, right? So I think there's an opportunity to pause and say, now that we've given you the recommendation and we gave you some other things to think about, how do you want to proceed? Do you want to go with the recommendations, or do you want to explore a little deeper some of the alternatives? But presenting those was really great. So Adam, you started things off, right? So again, the way you walked through sort of their SWOT analysis, I thought was really helpful, just sort of generally setting about the cash flow and the budget. The one thing I would have liked to see you do is, in the beginning, slow down a little bit, just talk, sort of set the agenda for what the 20 minutes was going to look like, so I understood where we were going. Your recommendations were great. I liked the visual of the credit card snowball. That was a nice way to think about it. And then that one chart you had that detailed the difference between what you're doing in 2021 or what we're recommending 2014, that was perfect. That hopefully will spur some action for the client. So Sam, you moved on to family planning. That was impressive research. So we've been talking all day about how that's a challenging topic to go into, and it's sort of maybe out of the scope of to the traditional financial planning areas. And you did a lot of great research to look at the pros and the cons, and I get the sense you had a list of agencies ready to go and lawyers to use. I mean, that's really admirable, and I think would really help these clients sort of think through things. Mentioning things like the tax credit, how to pay for some of it with a gift from Mark's parents, all really, really great stuff. And then Scott, you closed things down with retirement planning. So again, the framework you guys used throughout the whole thing I think made a ton of sense. The one thing I would love to see is, you mentioned the $4.2 million a few times. I would have loved you to spend just 60 seconds and explain, okay, here's really where that $4.2 million is coming from. Because that seems like a big number. The client's net worth is a couple $100,000. So $4.2 million seems like a lot now. We all know it's actually not that much, but to slow down and just say, hey, let me tell you where this number is coming from would be really helpful. At the end, I thought you did a fantastic job wrapping it up. So being very specific to say, here, as a client, these are your to-dos. As the advisor, here's our to-dos. And then a quick summary of the 5 major recommendations. I think you really ended that well.
I think you all did a great job overall. I did like the SWOT analysis, as David said, and I also like the debt elimination comparison. So kind of hear what you're doing now, and then here's kind of what we recommend and how that'll save you money and stuff over the time frame. I really appreciated that. I like that you presented a lot of different options in all of the sections, basically. Across the board, you had a lot of different options. I like that you recommended the adoption attorney, to take that a little step farther as well. The summary was really good. There was a couple places where you didn't have income taxes as your topic, but you did allude to some taxes, so maybe you could have took that a little farther and recommended them contacting the income tax attorney or CPA, whatever the case being in that different area. And then also maybe touching on, and this came up when you talked about the joint income and the SWOT analysis being, and that would have implications for taxes, but maybe just saying how that could now have implications because before it could not. Yeah, but good job.
In addition to what has already been said, I also very much like the framework of the SWOT analysis, because in that you've covered yourselves to make sure that you're providing praise to the client for their strengths, what they're doing well, but then also recognizing opportunities for improvement. So that's a great framework to use for that. Some of the assumptions you used, like in the beginning, Adam, where you talked about your overspending by 20%, says who? Where did you get that number? What is that based on? And then the page where you were showing how to save $8,000, maybe I was taking too many notes, but I wasn't sure where that was coming from and how I saw the bottom line number, but I didn't really catch. So maybe a little more explanation there. Sam, I thought you did a really good job dealing with the issue of the family planning, and particularly just recognizing up front, this is a very personal decision, but there's also a financial implication to it, so we need to look at both of those areas. Scott, with the discussion about retirement, I echo David's thoughts of the $4.2 million, maybe a little more background on where that comes from, but I liked that you kept it general. I have seen other presentations that say you need, $4,1,907,035, and it's like, wow, in 26 years, that's exactly what I need. So the way that you kept it more simple and that you recognize this number is going to change, we have, life will happen, we'll be reviewing this, was good. And then in the discussion about risk, it was good to recognize here's where you are with your asset allocation, here's where we could be based on your risk tolerance, but you didn't really talk about risk in any detail. A simple questionnaire, even though it indicates they could probably stand a little more risk, I think a more explanation of that and what that would potentially look like on the upside and downside would be good information for the clients. So, but great job, really good framework and good visual support to your presentation.
I don't know for the people. Not least, University of Georgia. I can, as you know, gentlemen, as you know, these are your clients. They will not react. The judges are from each one of the partners, CFP Board, Ameriprise, and FPA. Dr. Gillen is representing CFP Board. David is representing Ameriprise, and Valerie Porter, David Breslin, and Valerie Porter is representing the FPA. Now, and representing the University of Georgia is, where are you? There you are. Kelsey Brooks, Chase Burkhart, and Matt Riggins. I got some nice easy ones that time around. That's good. So the rules for people who are in here, they have set up, once we start, they will have 20 minutes. Originally the written plan they gave was without financial planning software. This is the oral presentation phase. All of the teams to have a common thread were required to address the retirement needs. Then they were free to pick 2 other topics within it. As they go through the presentation, the judges will not react. They are instructed to do so, and I will be holding up cards at 5 and 2 minutes, and if the team does go over, I will have to stop them. So with that said.
Ready to begin whenever? Okay. Good afternoon, Mark and Jeffrey. It's so nice to welcome you back to Axiom Wealth Management today. We hope that you have had time to review the plan that we've created and sent to you since our initial meeting. I'm excited to hear how you're both doing today and especially how your businesses are going. Also, I know I've served as your initial point person and we have an established relationship, but today I would like to introduce you to the whole team here at Axiom Wealth Management and introduce you to the other principals, Chase Burkhart and Matt Riggins. As you know, the plan we sent you is a comprehensive plan, and today we'll be focusing on the areas of cash flow, retirement, and estate planning. Our goal for the meeting today is to go through the plan with our recommendations as well as address any concerns that you both might have. We are always available by phone, email, or in person to answer any questions. We really want to be here for you and help you grow and feel very comfortable with and confident in your financial plan. To kick things off, Matt's going to go over the initial goals you had coming into our meeting.
Yeah, so to go over your initial goals, first your short-term goals were to establish an emergency fund, and then you wanted to become debt-free other than your mortgage by paying off your credit cards and other loans that you had. And you also said that you wanted to reduce worry and discussion on money. And then on your intermediate and long-term goals, you discussed that you wanted to figure out a way to your effective use of bonuses and other gifts that you get, and then to explore the differences between adoption and surrogacy and establish a vacation fund. And you also discussed wanting to purchase a few investment properties, and you also wanted us to do a retirement analysis and formulate an estate plan for you.
Absolutely, and I appreciate you going through that for us, Matt. From our perspective at Axiom Wealth Management, our main goal is not only to help you achieve your short, intermediate, and long-term objectives, but more importantly, to do so in a way that maintains your current lifestyle, is consistent with your core values, and allows us to build a lasting wealth into the future for you. So with that said, let's get into more specifics of the plan.
Yes, exactly. First, we're going to discuss, as I said, cash flow. We really are going to focus on eliminating your debt, because that's one of the main goals you came into our initial meeting with. First, I'm going to discuss your 2012 annual income and expenses with the information you shared with us in the last meeting. Mark and Jeffrey, both your combined incomes are right around $335,000, and then your non-discretionary or necessary spending is right around $300,000 annually, and your discretionary flexible spending is right under $50,000, which leaves you with a negative cash flow of $20,000. Again, just cash flow is really important to our firm because it's the foundation of your plan. It allows us to determine your income as well as track your expenses, and allows us to better develop recommendations for both your short-term and your long-term and intermediate and long-term goals. As you can see, we really want you to be able to maintain a comfortable lifestyle. We understand and realize that it's expensive to live in New York City, so our main plan doesn't have you making drastic spending changes or changes in your behavior, which we think is really important. Alternatively, though, if you were to drastically cut your expenses, you could reduce your debt at a quicker pace, but we have you paying your debt off within a year, so we didn't really see the need to have drastic changes. Moving forward, to pay off your debt, we plan to use the extra money that you received from already refinancing your home, as well as dedicating Jeff's $27,000 bonus, as well as the $50,000 gift from Mark's parents between your flexible accounts, such as your emergency fund, retirement savings, as well as towards your credit card debt. And your main goal, again, as we've reiterated several times, was to be debt-free other than your mortgage. But Matt's going to go into a little bit detail of maybe another way you could continue to save for retirement as well as pay off your debt.
Yeah, so alternatively, instead of paying off your debts over the course of 1 year, you could pay them off over a number of years and then channel that extra cash flow into your retirement accounts. Thereby, you would get a tax deduction, and you'd get to enjoy the wonders of compound interest over a longer period of time. And yes.
Absolutely, and we can work with you to negotiate down your interest rates on your credit cards with your creditors as well. If you're able to lower those rates, that makes that alternative an even more attractive option. However, our plan, standing as is, will continue with the goal of eliminating your debt as quickly as possible because you guys so adamantly stressed that in our initial consultation.
Again, this is something we can discuss at a future meeting, or if you have any questions about this, we can discuss it further on. Lastly, for your cash flow, another important element is taxes. With the recent legal changes, which Chase will discuss later on in the estate portion, we would be happy to help you look into seeing if amending your taxes over the past few years would help increase your cash flow. We also recommend that you go talk to a CPA. We would be more than happy to recommend one, or if you currently are working with one, to help them join the team. Now we're going to go into the future projections of our cash flow recommendations.
Sure. So Currently, a current snapshot of your current financial picture is a place of limited savings. You currently have $0 in your emergency fund, and the vacation and home improvement funds that you wish to create do not yet exist. So if we project those numbers out for 5 years following the implementation of our recommendations, we're able to not only eliminate your debt outside of your mortgage within 1 year, but we're also, in 5 years, able to build an emergency fund that houses around $65,000, a vacation fund housing $30,000, and also create a home improvement fund, which can be made for improvements on your current house or future investment properties that you wish to have of $20,000. You might be thinking to yourself, a $65,000 emergency fund doesn't sound like very much for a 5-year projection with our current rate of expenditures. But keep in mind that the vacation fund and the home improvement fund can be seen as more discretionary funds, and in the case of an actual emergency, those funds can be used as a source of emergency funds as well.
Yeah, and to piggyback off of what Chase was just saying, your net worth as of right now is $385,000. But in 5 years, we'll more than double that to $780,000, and your assets will be over $1 million.
Yes, just to wrap up cash flow before we move on to retirement, our recommendations are we have a plan for you to pay off your debt within a year, to fund necessary accounts such as your emergency fund, and the effective use of any future money such as gifts or bonuses. Now that we've discussed your current situation, we're now going to move into your future, your retirement. Matt?
Yes, thank you. Our goal is to make retirement savings as painless as possible for you. We did it when we ran your analysis. We came up with a retirement need of approximately $10.1 million. And with your current retirement savings and other gifts, your inheritance and stuff, you're right at $4.2 million in savings. This will create a retirement shortfall of $5.9 million. I know you're thinking that's a lot, but with our plan, we believe that you will be able to close that gap. With our plan, what we did was we created a step up in retirement savings. So over the next year, you would be paying off your debt, and we started out at 2% retirement savings, and that would go up by 2% a year until you reach a 16% retirement savings rate.
Yes, and Mark and Jeffrey, I just want to address, maybe you have a concern with 60%. That does seem like a lot of your income, and is this even a realistic goal? Chase, can you go into a little more detail about how this is an achievable savings rate for both Mark and Jeffrey?
Sure, and we completely understand that apprehension, but we think the beautiful thing about this retirement strategy is how completely it synchronizes with our cash flow recommendations as well. It allows you, during the time where you're paying down debt and emergency funds, to save at a lower rate. And as cash flow from your growing businesses increases exponentially, in addition to the gift strategies that we have implemented as well, it allows you to save more rapidly in the future and fully fund your retirement.
Yes, and how you should put this retirement savings in your accounts is first, Jeffrey, the 401k that should be set up at your business next year, you'd want to fund that until you meet your match in the 401k. And then you want to split the rest between Mark, your SEP IRA, and Jeffrey's 401k, and then until you max both of those out. And then any remaining investments or retirement savings that you need to do, you'd put in a taxable account. And this could include annuities or brokerage accounts or any other investment accounts. And as you can see, if you follow our recommendations, our projection is that you'll meet your retirement needs at when you retire.
$10 million.
Just to lastly wrap up our recommendations one more time, is we're going to begin you saving at a 2% rate of your income and increase that at a 2% annual step-up rate as we go along, and we do project you to fully reach your $10 million retirement need. Any additional savings that we can allocate will be spent to brokerage accounts or annuities outside of the already established IRAs and employment retirement accounts.
Now that we've discussed your retirement, we're going to move into the estate plan portion of your plan, which we're really excited to share with you, especially with the recent legal changes.
So I'm sure you've heard and have been celebrating the fact that the Defense of Marriage Act, specifically Section 3 therein, has been struck down by the Supreme Court this July. That specific section was the one that denoted that for federal recognition purposes, marriage was only between a man and a woman, which is great now that it's been struck down, because for same-sex couples that reside in states that have previously recognized same-sex marriages, they will be able to take advantage of federal benefits as well. A current snapshot of your current estate, we combined your estates and totaled that to about $360,000. This leaves you well below the $1 million New York State limit and also well below the 5.25 individual limit for federal estate tax limits. Obviously, as we work together throughout your lifetime, your estate is going to grow rapidly. But we'll have to revisit on an ongoing basis how this relates to estate tax purposes because the federal exemption limits and state limits change very often and just need to be monitored as the plan goes forward. You guys have already built a very, very, very solid foundation previously to meeting with Axiom Wealth Management to a building an estate. You have established wills for the transfer of your assets. You have living wills, which let you make life-ending decisions now for if in the event of an emergency and incapacitation. And you've also already signed medical powers of attorney that protect your spouse's decision-making rights in the event of incapacitation. The medical powers of attorney, and specifically, they are typically assumed that a spouse has those rights, but we recommend keeping those in effect just in case an accident that results in incapacitation occurs outside of the state of New York. It'll make sure that you're protected and your spouse can continue to make sure that they have that decision-making ability. Now moving on to some of the things that are going to change because of the strike down of the Defense of Marriage Act. First and foremost, you're going to be able to take advantage of the marital deduction. This simply means that you'll be able to transfer an unlimited amount of assets outside of gift or estate tax implications to your spouse, and it won't take up any of your individual $5.25 million federal exemption as well. Our biggest recommendation for your estate plan is to build and fund a joint living trust. We'll work with an estate attorney on this and with you to fund this trust with titled assets such as your automobile, brokerage accounts such as the ones we're going to create in excess of your retirement savings. Mark and Jeff, both of your business, your key employees or owners, so we're going to title your business interest into this trust as well, and also your bank accounts. Once we've funneled these assets into this trust, we can control both the disposition and use of these assets at death.
Chase, I know you've talked a lot about the benefits and the changes of DOMA and how that impacts both Mark and Jeffrey. And now can you explain a little bit why it's a good idea to have a trust in addition to the already established wills?
Absolutely. You might be asking why, if we already have an established will, why do we need a trust? And the answer is to avoid probate. If you just use your will, you're going to go through a process named probate that is a public and legal process by which your liabilities are paid and your assets are distributed. The issue with probate is, while yes, it will make sure that your will is used as you want it, it can be very costly. There's often many, many delays that only add to the cost, and it is a public process. So this can be very expensive and very public for the surviving family members at a time that's very emotionally tumultuous. The good thing about a trust is the fact that we build it now, fund it now, your assets will be automatically transferred at death outside of probate, which will keep costs low, automatically transfer again, and keep the matter private, which is the best benefit we can give to a surviving spouse and family. Lastly, now that you're a federally recognized couple, you'll also be able to take advantage of the benefits of Social Security and disability benefits of your spouse. I'm going to let Matt briefly expand on that a little bit because it has some great implications about your retirement plan.
Absolutely, I'd love to. Now, before DOMA was repealed, your Social Security benefits were entirely separate. Jeff, you got yours, and Mark, you got yours. And should one of you die before the other, your Social Security benefit would be lost to the spouse. And now, with the passing or the repeal of DOMA, you get a spousal benefit, which means that if one of you has a higher Social Security benefit than the other, the spouse will get the higher Social Security benefit. And you also will receive the survivor's benefit. This means that should one of you predecease the other will receive a portion of your Social Security benefit.
And most importantly to us, from the perspective of Social Security, that decreases your need for retirement savings by over $700,000 through your savings lifetime. Obviously a huge benefit to us moving forward. Just to wrap up a little bit about our estate plan, once again, we're going to build and fund a joint living trust with your estate attorney. Once again, I want to talk about the establishment and that relationship between your financial planning team, yourselves, and an estate attorney. It's going to be paramount that we have a working relationship with one moving forward. It's really the only way to properly and legally ensure that a good estate plan is made. Lastly, we would like to double check that you have both named your spouse as the beneficiaries of your retirement accounts at work as well. And lastly, I think we have a little bit of extra time. In our initial consultation, you had previously spoken about your wish to possibly grow your family one day. First and foremost, we want you all to know that we've built this financial plan in a way that's completely adaptable to that scenario, and we'll modify it as such. I think it might be prudent at this time to speak a little bit about the initial costs of an adoption or surrogacy.
I'd be happy to, Chase. Just to let you guys know, there is a difference in cost of adoption based on international or domestic. The average cost for domestic adoption begins around $25,000, whereas international is around $35,000. And surrogacy is a little more expensive, with the average cost ranging around $100,000. We understand that starting a family is a really big decision, yet it's also expensive. So there are financial loans and grants that are out there and available, and we are more than willing to work with you to find these, as well as help you with the process in any step of the process, whether it's finding an adoption agency, a surrogate, as well as finding an attorney that specializes in family law. As Chase said, this is a living document. We are more than happy if this is something that you both desire. We will rework it into our financial plan. Now to wrap up the meeting, just to kind of go over briefly what we discussed. Within your cash flow, we have given you a solid plan to eliminate debt within a year, as well as through retirement, establish a savings plan. And estate planning, we have discussed the legal changes and what you need to do to make sure that you are protected.
And just if I can interject real quickly, I want to say that with all this accomplished, our main point we really want to hammer home is we were able to accomplish all these and put you on a path to future financial success, all while not changing your current lifestyle, which you've come to know and love. Yep.
Just real quickly to go over for future issues, we will discuss in more detail adoption and surrogacy, as well as our next meeting, discussing the investment analysis. And as we've mentioned several times, this is a living document, so it will require ongoing monitoring of the plan, which we will discuss at all future meetings. And on your way out today, please schedule your next meeting with our receptionist.
And lastly, on behalf of myself and all the other principals at Axiom Wealth Management, Matt Riggins and Kelsey Brooks, Mark and Jeffrey, we just want to thank you so much for bringing us into part of this process and what we view as a really great relationship that we hope to carry on into the future. We believe that you can achieve everything you wish to in your future, and we really look forward to our work together. Thank you so much.
Appreciate you choosing us, so thank you.
Thanks a lot. Once again, the judges will get their notes together.
This one works as well. First off, I just want to say you had the worst position all day. Last position, I can only imagine what you had to go through for the last 6 or 7 hours waiting in the shadows, waiting to come out. So great job working through things. I want to offer sort of just some general thoughts, and then we'll kind of talk about the individual pieces of the presentation. So yeah, there's something interesting that you did really well as a team, which is you approached it in a way that was very realistic to how things actually happen in an office. So the three of you worked off each other, which is actually how it works, right? And when you're sitting down with a team of advisors, they play off each other, and I think you did a great job playing off each other. The other piece that I really was impressed about was I got the feeling that your fictitious firm is kind of like a family, and I felt they're kind of like warm and fuzzies, and that's a hard thing to give off in a little presentation like this. So I thought you did a great job there. The one sort of general opportunity, I think, is to get a little more specific with some of the recommendations. And I'll talk about that in a little bit, but with a lot of sections, you talked about, so sometimes advisors talk about cause and effect. You actually kind of did the opposite way. You talked about, if you follow our recommendations, here's what things will look like, which is really helpful, and actually I think a really great way to get people to take action. But when you get to actually talking about, well, here's what specifically to do, at points I was looking for more specifics around actual things I can go do tomorrow or you can help me with. So just to kind of dive into the presentation, I like the way you worked through cash flow. And by the way, the presentation itself I thought was super professional. The graphics you used, the fonts you used, like all that stuff actually really matters, and it made things really easy to understand. There was never too much text on the screen, which was really great. A couple of interesting things I thought you did. So you talked about having the cash reserve, and then having money for the home renovation, and kind of the idea of dual purpose money. That was a great idea, and one that I'm not sure all clients kind of put together. Your step-up schedule for retirement, another great idea, to take somebody who isn't necessarily saving enough, and instead of saying you got to save 16%, to build it up over the years. It was a great idea and a great way to lay it out. And you did a really good job of addressing the fact that this is a big change, and it's going to take some time to get there. Again, what I would love to hear is more specifics about why you chose the different retirement accounts one over another. What's the pros and cons? What are different options? What else did you consider? With estate planning, honestly, I think the three of you nailed it. So estate planning for clients like this is super important, and it doesn't have to be massively complicated, but you got to get the basics right, and you talked about the basics, which was, I thought, phenomenal. So you did a great job summarizing the key points from the DOMA decision, talked about the difference between trusts and wills in a way that made sense to me as a client, talked briefly about the need to look at beneficiaries, make sure that's all locked and loaded. I mean, that's the sort of the core stuff that financial planning sometimes we get wrong or we forget to do, that you did a great job of. And then throwing in the adoption piece at the end as a little extra credit was nice to see too.
Yeah, I thought you all did a great job as well. I really liked how you did play off of each other, and Kelsey would say, could you explain more about this, or so-and-so's going to tell me more about that. I thought you did a good job explaining DOMA and the benefits and kind of the pros and cons of some of that, and thinking through it as well, and even possibly looking at amending taxes, which do kind of have pros and cons. I think you recommended a lot of very appropriate professionals as far as CPAs, estate attorneys and such with going in that. And I really like that Chase talked about negotiating the credit card terms. I thought that kind of went above and beyond a little bit too, and definitely very doable, and definitely might help as well. I did hear a little bit of jargon, so maybe brokerage accounts, a few terms maybe just to clarify a little more, put into layman's terms where I might understand it better as a client. I think that's the gist of it. David covered a lot, so, but I agreed with.
He did. The only thing that I would add is that I like the way, Chase, I like the way you, in talking about the retirement savings plan and stepping up, how you talked about the synchronicity there with the cash flow plan, just tying it all back together. And the play that you had off of one another was great, because it helped everything flow, and it wasn't like, I only looked at this area of your plan and I only looked at this area. It was good that you were working together as a team. I felt warm and fuzzy too. I also liked that you guys were consistent in bringing back the lifestyle, wanting to protect that lifestyle. You can tell in the case study that it's important to them, that they have these goals, but they don't necessarily want to have a drastic change in their lifestyle, and that was good that you kept recognizing that. I would be careful using language like should. You should do this, you should do that. That's never easy to hear, even if we know it's true. So maybe softening the language, consider this, or here are some options for you. And then I liked the way you praised what they had already done with their estate planning, and then showing what they could do differently. Again, a little bit of jargon there, the disposition of assets. What's happening with them? They're disposed. I don't know what that means, but it doesn't sound good. But overall, very good. Great presentation.
I'm not a judge, but I will put a couple of points because this is my area of specialty. Two things. You did refer to his spouse as his spouse, which was terrific. And believe it or not, those red lines going through that part of Section 3, emotional. I mean, that is something that they're going to be hyped about. So terrific stuff for that. And that's included people who are planners out there. If you have a same-sex couple, celebrate with them. They will really enjoy it. That concludes the competition. As I said, it was really good stuff we heard here today. Excuse me? Phase 2 of the competition, I'm sorry. That for the day's competition. Yes? We're doing that at right there, but thank you. There's my shill. The sponsors, once again, it really is. We have worked on this, and it is really a wonderful relationship we have. We hope we go far into the future with this. We have CFP Board, we have Ameriprise, and then Financial Planning Association. And then we have all the program directors who are with us, too. So I think we can make this go wonderful places. Competition, I think phase 2 of the competition was great. Tomorrow in the afternoon, same place, there will be the more fun, less stressful, yeah, right. There's going to be like a game show type of thing, how do you know? And we do have a little twist. The twist, in case you know, so I think it will be a lot of fun. What we're going to do, and you're going to hear this too, is that we're going to have the planners who come in here are going to also compete with you as well. They're going to be texting A, B, C, D as the students are doing it, and we're going to see how the planners do against the students. So it should be a new twist, and it should be a lot of fun. All right? Thank you so much. We'll see you tomorrow.